Please like, share, and subscribe. Wishing you happiness and good luck every day.
Whether it's tulip bulbs back in the 1600s, internet stocks in the 90s, or even housing in the 2000s, the names and the assets change, but the story, well, that stays terrifyingly the same. It always starts with this wave of just intoxicating euphoria, this belief that, hey, the old rules don't apply anymore, and then the inevitable, devastating crash. You see, these market manias, they're one of the most consistent patterns in all of financial history. They're exciting, no doubt. They create incredible wealth on paper, but they always end in ruin. So the big question is, why? Why do we keep falling for the exact same trap over and over and over again?
And this quote, man, it just perfectly captures that feeling, doesn't it? When you're in it, it's not really just about the money. It's about feeling like you're part of something bigger, a revolution. You're not just some investor, you're a visionary. And all those old-timers, the ones with their boring blue-chip stocks and their constant warnings, they just don't get it. This is a new era, a whole new economy. The story is just so compelling, and as the prices keep going up and up, that euphoria, it starts to feel totally justified. It feels like it's going to last forever. But here's the thing, it never does.
And believe me, this is not a modern problem. This is a pattern that is centuries old. I mean, look at this. 1637, tulip mania. A single tulip bulb was trading for the price of a mansion. It's insane. Then, 1720, the South Sea bubble. Shares in a company with let's be honest, a really shaky business plan created this massive frenzy all across England. Jump forward to the Roaring '20s, which of course ended with the Great Crash of 1929. And then, in our own lifetime, the dot-com bubble. You see, different times, completely different technologies, but the human behavior, it's a perfect mirror image every single time. There's always this mesmerizing new thing that just makes investors throw all the old rules, all the traditional standards of value right out the window.
And here's the aftermath, the horrifying scale of the destruction that comes right after the party ends. After the '29 crash, the market didn't just dip, it evaporated. It lost 89% of its value. Just think about that for a second. Almost 90 cents of every single dollar just gone. And that's not some weird outlier. Tulip prices, they fell over 99%. The South Sea Company, down 88%. See, the aftermath of all that euphoria isn't a gentle correction. No, it's a cataclysm. It completely wipes out a generation's worth of wealth and trust.
Okay, so this brings us to the big question, right? We've seen the what, this repeating cycle of boom and bust, but the real mystery is why. I mean, if history gives us this giant flashing warning sign, why on earth do we just ignore it every single time? Well, the answer isn't buried in some spreadsheet or a complicated economic model. Nope. It's inside our own heads.
All right, so to really get why we act so irrationally, we first have to tackle the official story. The one that dominated academic and financial thinking for decades. And that's the story that insists we're all perfectly rational beings. So let's pull back the curtain on this theory. It's elegant, for sure, but as we're about to see, it's also deeply, deeply flawed.
So, meet the main character in this official story, or maybe the antagonist, the efficient market hypothesis, aka EMH. Now, in the world of EMH, every single investor is basically a perfectly logical supercomputer. Every scrap of information, every news report, every earnings statement is instantly and correctly processed by everyone. And what that means is that the current price of a stock is always its true fair value. It's a beautiful theory, right? It's mathematically clean, and its main takeaway is pretty simple. You can't beat the market, because the market is always right.
And this right here is the central conflict. On one side, you've got the EMH investor, the perfect, rational, emotionless machine. And on the other side, well, you've got us, real, actual investors. We don't just process data, we feel it. We get greedy when things are going up, and we get terrified when they're going down. We use mental shortcuts, we go with our gut. The gap between these two, it's not a crack in the theory, it's a canyon.
So for a huge chunk of the 20th century, you can kind of think of these academics as, well, as conquistadors in tweed jackets. They were searching for their own El Dorado, their mythical city of gold. Only their city of gold was this perfectly efficient market, a place of pure logic and reason. And they built all these complex models and grand theories based on the idea that it existed. But just like El Dorado, it was never actually found in the real world. They were chasing a ghost.
And look, reality has a funny way of delivering a pretty harsh verdict. Take 1987, Black Monday.
there were these complex trading strategies called portfolio insurance, all built on EMH ideas. They were supposed to protect everybody. But instead, when the market started to fall, their automated selling actually accelerated the crash. Why? Because the perfect orderly market the theory promised just wasn't there. Then it happened again. In 1998, a hedge fund, long-term capital management, and get this, it was run by the Nobel Prize winners who came up with these theories. Well, they made a bunch of perfectly rational bets that went so spectacularly wrong, they almost collapsed the entire global financial system. Time and time again, the real world proved that elegant math is absolutely no match for good old-fashioned human panic.
Okay, so if the whole rational model is busted, then what is the real engine driving the market? Well, the answer isn't in an economics textbook. It's in psychology. The flaws aren't out there in the market. They're in here. They're in us. They are hardwired into our brains. They're consistent. And, this is the most important part, they are predictable. So first up, we've got something called the affect heuristic. Look, it's just a fancy way of saying going with your gut. When we get a really strong positive or negative feeling about something, that emotion just takes over our decision-making. The classic example from the dot-com bubble is etoys.com. Great name, right? Great story. It just captured all the excitement of the internet. That positive feeling was so powerful that investors completely ignored the fact that the company was just burning through cash and had no real business plan. The good vibes totally drowned out the terrible financials, which, by the way, were right there for anyone to see. All right. Next up is the durability bias. This is our brain's tendency to just take whatever's happening right now and assume it's going to happen forever. A company reports amazing earnings, and our brain just goes, yep, they're going to grow like this forever. This right here is the psychological engine of a bubble. And it works the other way, too. When bad news hits, we act like the company is doomed and will never recover. That leads to panic selling. The bottom line is, our brains are just terrible at figuring out when the party's going to end. And then we've got this one, representativeness. See, our brains are basically pattern matching machines. When something new comes along, we instantly scan our mental files for something that looks kind of similar. So when the internet popped up, investors didn't just see it as a new technology. No, they saw it as representing a new era, just like they did with radio and planes back in the 1920s. And because of that superficial similarity, they decided, hey, the old rules of valuation, they don't apply anymore. This is that little voice in your head that whispers, this time is different, which, as you probably heard, are the four most expensive words in investing.
You know, all of this leads to a really dangerous paradox, and this quote just nails it. Studies have actually shown that when people get more information, their accuracy doesn't really get any better. But you know what does? Their confidence. They become more and more certain that they're right. So you get these experts buried under mountains of data, and they don't just end up being wrong, they become wrong in depth. They build these incredibly detailed, super complex, and totally confident arguments for a future that just never happens. More information doesn't cure our biases. A lot of the time, it just makes them stronger.
So if we know markets are driven by these predictable psychological flaws, well, that leads to a really interesting question, doesn't it? Can you actually build an investment strategy around them? The answer is a resounding yes. It's called contrarian investing, and it's all about turning the market's irrationality into your single biggest advantage.
Here's the absolute core of it. The market consistently overreacts. It's what it does. When the news is good, investors get euphoric and they bid prices way, way up, far beyond what they're actually worth. That's those biases we just talked about. And when the news is bad, they panic and they sell stocks for far less than they're worth. A contrarian doesn't try to predict the news. They're not a fortune teller. They just wait for the market's totally predictable emotional overreaction and they bet against it. It's simple. They buy fear and they sell greed.
So how do they actually do this? Well, it's not with gut feelings. It's with data. Contrarians use these simple, time-tested metrics to find the stocks that the market has basically emotionally thrown in the trash. Things like a low price-to-earnings ratio, which just means the stock is cheap compared to its profits. That's often a huge sign that a company is just deeply unpopular and overlooked. Or a high dividend yield, which can mean the market is just way too pessimistic about a company's future. These are real tools you can use to systematically find where the market has overreacted.
And look, this isn't just some nice-sounding theory. The power of this approach is sitting right here in the data. What we're looking at here are stocks broken into 5 groups based on their price-to-cash flow ratio. That's a key contrarian metric. Now, over a 22-year period, the group with the lowest ratio, in other words, the cheapest, most unpopular stocks, they returned 20.1% per year. In the group with the highest ratio, the popular, expensive glamour stocks, only 10.7%. I mean, the data is irrefutable. Buying what's out of favor has historically been a much, much better strategy. You're literally getting paid to bet against the crowd's emotions.
Okay, let's look at it another way. This time with the classic price-to-earnings ratio. And guess what? The story is exactly the same. Between 1963 and 1985, the group of stocks with the lowest PE ratios returned 20.7% a year. The highest PE stocks, just 10.4%. Again, you're looking at almost double the return, simply by systematically buying companies the market hated and avoiding the ones it was in love with. The pattern here is just so consistent and so compelling.
All right, the evidence is pretty overwhelming. But the big question is, how do we actually put this into practice? How do we train our own brains to think differently, to avoid these psychological traps that get so many other people? Well, let's build a practical toolkit.
Okay, here are 4 simple rules to keep in mind. First, check for financial strength. An unpopular company still has to be strong enough to survive until people change their minds about it. So look for low debt. Simple. Second, be incredibly wary of forecasts from experts. We've already seen how unreliable they are, and how they're almost always too optimistic. Third, you have to actively use the market's overreactions. When everyone is panicking, that's your signal to start looking. When they're popping champagne corks, that's your signal to be careful. And fourth, and this is probably the hardest one, be patient. This is not a get-rich-quick scheme. Contrarian returns are earned over years, not days.
So if there's just one thing you take away from all of this, let it be this right here. For way too long, we've been taught to treat the market like it's some kind of math problem that can be solved, like it's a physics experiment with predictable laws. But we've been looking in the wrong place. The market isn't a math problem, it's a human drama. And it's filled with characters driven by hope and fear and greed and all those biases we've been talking about. Success isn't about finding the perfect formula. It's about understanding the characters and understanding the plot.
And that really leads us to one final question. Because at the end of the day, financial markets are driven by stories. Every investment you make is based on a story. Maybe it's the story of a new economy that's going to grow forever, or maybe it's the story of a fallen company that's never going to recover. So the most important thing you can do as an investor is to just step back and ask yourself, what story am I telling myself right now? Is it one of those euphoric stories fueled by all the biases we've just gone through? Or is it a story that's grounded in the long, messy, but remarkably consistent drama of human behavior? What story are you telling yourself?
You know, when you think of financial bubbles, you probably picture these weird, isolated moments in history, right? Like Dutch tulips in the 1600s or the Roaring '20s. But what if they're not just some historical oddity? What if they're actually a fundamental, repeating pattern of human behavior that's, believe it or not, speeding up? Today, we're going to peel back the layers of this collective madness and try to understand the pattern that seems to haunt us over and over and over again. So here's our game plan. We're going to start with a story, a firsthand account of what it actually feels like to be caught inside one of these things. Then we'll look at how history has this frightening way of echoing itself. After that, we'll break down the anatomy of a mania piece by piece. We'll dive into the psychology of crowds, and finally, we'll tackle the big question. Why does it feel like we're living in a new age of bubbles? You know, to really get what a bubble is all about, you can't just look at charts. You've got to understand what it feels like from the inside. So, we're going to jump in a time machine back to the late 1960s for a very personal story of pure euphoria, total madness, and a very, very hard lesson. I mean, that question really says it all, doesn't it? This was the go-go bubble of the late 60s. It was a time when it genuinely felt like the old rules were just gone. A new generation was getting impossibly rich, and it felt like the party was never, ever going to stop. Yeah, this wasn't about making a nice little 10% return. The feeling was, if your stock didn't multiply your money, you were wasting your time. And the old-timers who warned it couldn't last, they were just written off as fogies who didn't get it. This time is different, everyone said. The euphoria was absolutely electric. And here's where it gets kind of wild. The mania seeped into every corner of life. A group therapy session, of all places, basically turned into an investment club. And get this, one guy, acting on a single tip from the group's self-made stock guru, became a multimillionaire. He went from feeling like a total failure to a titan of industry overnight. But when the bubble popped, that entire world just vanished. Poof, gone in an instant. And that right there is the key takeaway. Even someone who had studied financial manias, who knew the history inside and out, got swept up in the frenzy. It's a powerful reminder that knowing about bubbles intellectually and actually surviving one emotionally, well, they're two completely different things. The ride to the top is incredible, but the crash, it's just pure destruction. Now, that story from the 60s might sound like a crazy one-off event, but it's not. Not even close. You see, sometimes history doesn't just rhyme, it's practically a carbon copy. And frankly, it's pretty terrifying when you see it line up. Okay, so play along with me here. Just picture the scene. The market, which had been flying high, starts to wobble. Every time it tries to rally, it fails. Then the margin calls start, brokers demanding more cash, forcing people to sell. Panic starts to set in. And right on cue, the President of the United States comes on the air to tell everyone, don't worry, the economy is fundamentally sound. Any guesses what year I'm talking about? Well, the trick question is, it could be 1929, or it could be 2008. The parallels are just staggering. It's the same script, almost word for word. A president trying to calm the nerves, a Treasury secretary from the top of Wall Street, the exact same sequence of market events. It's like history handed us the playbook for disaster, and we just followed it step by step 80 years later. If you want to grasp the sheer devastation of the 1929 crash, you just need to look at this one number, 89%. Just let that sink in. Nearly 90% of the market's value just gone. It was an economic earthquake that took an entire generation to recover from. And in 2008, the horror story was a little different, but just as deep. It wasn't just about stocks. This time, the very system of credit, the oil that keeps the engine of commerce running, completely froze solid. For a moment there, the global economy was staring into an abyss we hadn't seen since the Dark Ages. So if these disasters keep repeating, there must be some common DNA, right? They must share some traits. So let's put on our lab coats for a minute and dissect the anatomy of a bubble. Turns out there's a recipe, and the ingredients rarely ever change. And here it is, the 7-step formula for financial disaster. It usually starts with a genuinely good story. The economy is doing well. Then people start borrowing like crazy. Soon enough, old-school valuation methods get thrown out the window because, you guessed it, experts tell us this time it's different. Even people who know better jump in, hoping to sell to an even greater fool. And it always ends the same way, a mad, desperate scramble for the exits. Now this is the big one. New era thinking. This is the psychological trap that gives us permission to believe that the laws of financial gravity have been magically suspended. In the 20s, it was the magic of radio and airplanes. In the 90s, it was the internet. You find a great news story, and suddenly you can justify prices that are completely insane. And this is where things get really cynical. The greater fool theory is what pulls in the people who should know better. They see the bubble, they know it's a house of cards, but they think, hey, I'm smart. I can ride this wave and get out before it all comes crashing down. I'll just sell it to some other guy, a greater fool. The only problem is, when the music stops, almost everybody looks around and realizes they're the fool. Okay, so we know what a bubble looks like. We've got the anatomy down. But the real multi-trillion-dollar question is why? Why do we keep falling for the same trick? To answer that, we have to step out of the world of finance and into the weird, fascinating world of crowd psychology. This quote, from way back in 1841, absolutely nails it. Charles Mackay saw it crystal clear almost 200 years ago. As individuals, we can be rational. But when we get into a herd, we tend to lose our minds. We catch the madness like a virus, all at once. But recovering our sanity, that's a slow, painful process that happens one person at a time. And building on that, the psychologist Gustave Le Bon figured out a key weakness of our collective brain. A crowd doesn't operate on logic. It operates on images and feelings. And let me ask you, what image is more powerful, more seductive than the dream of getting rich quick with no effort? That one powerful image short-circuits all the rational parts of our brain. All right, we've got the history, the anatomy, the psychology, but this is the part of the story that's genuinely disturbing. This problem, it's not getting better. In fact, all the signs are pointing to it getting much, much worse. So just take a look at this. This is a list of the really big, world-changing bubbles before the Great Depression. In almost 300 years, from the tulip mania all the way to 1929, you can pretty much count them on one hand. They were like comets, rare, spectacular events that were generations apart. Now, look at the modern era. That nice, clean timeline is gone. In just the last half-century or so, we've had at least 6 massive stock market bubbles, not to mention countless others in real estate, crypto, you name it. They've gone from being a once-in-a-lifetime event to something that happens every single decade. And the price we pay when these things blow up is skyrocketing. The dot-com crash wiped out something like $7 trillion of wealth. A few years later, the 2008 crisis incinerated more than 3 times that, around $25 trillion. The scale of the destruction is escalating at a frightening pace. And here's the great irony, the paradox at the heart of all this. This is all happening today, right now, in an age where investors are supposedly the most educated, most sophisticated in all of history. We have supercomputers in our pockets with access to limitless data. So why are things getting worse, not better? Maybe, just maybe, the very technology we think is our shield is actually an amplifier, spreading the madness faster and wider than ever before. Which leaves us with this one final nagging question. We know the history, we know the script, we can see the pattern. So if we're all so aware of how these bubbles work, why do we keep letting them happen? If our modern world is just a high-tech echo chamber for our most ancient flaws, how do we ever break the cycle? That's the real question, isn't it?
Welcome to The Explainer. Today we're digging into a really fascinating puzzle. Why do smart, experienced people make completely irrational financial decisions? And what if I told you there's a hidden, emotional force in our minds powerful enough to drive massive market bubbles and wipe out trillions of dollars in the process? Okay, so here's how we're going to tackle this. First, we'll dive right into the mystery of market hysteria. Then, I'm going to introduce you to the psychological culprit behind it all. We'll break down exactly how it messes with our thinking, look at the evidence from one of the most famous market crashes ever, and then, most importantly, we'll talk about how you can build a defense against it. So let's just start with a fundamental question. It's something that has kept economists and investors up at night for, well, forever. And it gets right to the heart of how our brains work when there's money on the line.
Now look, this is not some academic exercise. This is the actual story of Red Hat software during the dot-com bubble. I mean, just let that sink in for a second. It perfectly captures that wild, almost unbelievable swing from total euphoria to absolute panic that can grab hold of even the smartest people and turn them into a frantic crowd. So how in the world does this happen? Well, to solve this mystery, we need to meet the prime suspect. It's this powerful psychological force that researchers are really only now beginning to fully get their arms around. And it's called affect. The thing you have to get about affect is that it has zero to do with logic or spreadsheets or analysis. No, it's your gut. It's that instant, automatic, emotional reaction, that I love it or I hate it feeling we get about, well, anything. An idea, a product, and, for our purposes, a stock. You see, our brains are basically running 2 different operating systems at the same time. We like to believe we're using the rational one all the time, the slow, logical, thinking brain. But right there, running in parallel, is this other system, the feeling brain. It is fast, it's intuitive, and in moments of excitement or pressure, you better believe it can just take over. And this feeling brain, which is basically fueled by affect, is the reason you get that instant jolt of excitement when you hear lottery win or that knot in your stomach when you hear market crash. It doesn't wait for data. It runs on images and stories. And its emotional punch is so strong it can completely override years of training and rational financial experience. Okay, so how exactly does this emotional brain lead us so completely off the rails? Well, it turns out that affect systematically messes with our perception of reality in 4 very specific ways when it comes to money. We're going to break down these 4 psychological traps one by one, and you really want to pay attention here because these are the hidden culprits behind huge investor losses over and over again throughout history. All right, first up, when an idea feels incredibly exciting, like getting in on the next big thing, our brains just become almost blind to the actual mathematical odds of success. The feeling of the potential win is so powerful, it just shoves the cold, hard probability way into the background. And this is just wild. One study found that people were willing to pay 1,000 times more for the exact same lottery odds if they just felt like they had a good chance of winning. It proves it's not about the math. It's about that feeling of possibility.
Okay, this next one, this is where things get really, really dangerous for investors. Affect takes a fundamental law of finance. Higher potential reward comes with higher risk, and it flips it completely upside down in our minds.
So if we get a strong, positive feeling about some hot new tech stock, our brain subconsciously decides, hey, the risks must be low. even when all the evidence is screaming the exact opposite. Our feeling brain basically tells us, this feels good, so it has to be safe. Number 3 is the durability bias. It's pretty simple. We tend to think that good times are going to roll on forever and that bad times are never, ever going to end. And this causes us to just dramatically overreact to everything. Good earnings reports, bad news, projecting a short-term blip way out into the distant future.
And finally, this bias makes us fall in love with these big, exciting, abstract ideas about the future. We get all hyped up about the new economy or the future of the internet, and we completely ignore the messy, concrete, and frankly often unprofitable details of what's happening right now. So, where can we see all 4 of these biases working together in a perfect storm? Well, the dot-com bubble of the late 90s is the absolute perfect case study. It was a moment when all these psychological forces collided to create one of the most spectacular and destructive financial manias in modern history.
Just look at this chart of the NASDAQ. It's the perfect picture of an affect-driven mania. You see that euphoric, almost vertical climb, fueled entirely by good feelings and exciting stories, and then you see the terrifying, stomach-churning plunge right back down to earth. At the absolute peak of this frenzy, investors were paying more than 200 times a company's earnings for its stock. Let me put that in perspective for you. A normal, healthy PE ratio is somewhere around, say, 15 to 25. This wasn't just optimism. This was a complete departure from reality. These stories were they were too good to question. Investors completely fell in love with the idea of these companies. I mean, for AOL's stock price to make any sense at all, it would have needed more subscribers than there were people on the planet. And eToys.com, a company with practically no sales and zero profit, was valued at 3 times the size of the established giant Toys R Us. People ignore these giant, flashing red signs because that good feeling, that affect, was just too darn powerful. This table is where you really see just how crazy it all got. Look at those PE ratios in '99. Yahoo at almost 1,200, eBay at over 1,900. I mean, these numbers aren't just high, they're meaningless. And then, the crash. Look at those prices just a few years later. The average decline for these supposed can't-miss stocks was nearly 80%. Just devastating.
So that brings us to the big question. How do we protect ourselves from this incredibly powerful, distorting force? Now, you might think the experts, the professional analysts, the fund managers, they must be safe, right? Well, the evidence shows something surprising, and to be honest, a little bit scary.
And here it is. This is maybe the most sobering takeaway of all. Despite all their training, their fancy models, and their access to incredible amounts of data, financial professionals are not immune. They fall into the exact same psychological traps as everybody else when affect takes the wheel. Their thinking brain gets hijacked, just like ours does.
So what's the defense? The answer is actually pretty simple, but it is not easy. It all boils down to this one powerful guideline. Stick to your rational analysis. Do the hard work of valuing a company based on its actual fundamentals, and then, and this is the hard part, have the discipline to trust that work even when the market's emotional tide is pulling with all its might in the other direction.
And that really leaves us with a final thought to chew on. This force, affect, it doesn't just operate in the stock market. It's part of our daily lives, influencing everything from the car we buy to the way we vote. Just being aware of it, knowing that this powerful emotional driver is always running in the background, that's the first and the most important step toward making smarter, more rational choices in every part of your life.
All right, let's talk about something that affects every single one of us, every single day. These hidden shortcuts our brains take that secretly steer our choices. We all like to think we're rational, especially when the stakes are high, like with our money. But what if I told you that your own brain has evolved to betray you in exactly those moments? We're going to uncover these treacherous shortcuts, and it all starts with a simple question.
So let me ask you something straight up. Don't overthink it, just go with your gut instinct. What do you think is the more likely way to die? All right, so you've got 2 options. Is it being attacked by a shark or being hit by a piece of an airplane falling from the sky? Now, almost everybody, when they hear this, they immediately think shark. And why is that? Well, because it's so easy to picture. We've all seen movies like Jaws, right? It's this vivid, terrifying image that's burned into our brains. But when's the last time you saw a movie about falling airplane parts? Probably never. Since that image isn't readily available, our brain just kind of waves it off as being super unlikely. But is it? Well, here's the reality check.
According to the data, in the US, you are 30 times, that's 30 times more likely to be killed by a piece of a falling airplane than by a shark. That gut feeling, the one that felt so certain a second ago, it was dead wrong. And the mental glitch that led you there, that's exactly what we're going to break down today. So here's what we're going to cover in this explainer. First, we'll get into why our brains even bother with these shortcuts. Then, we're going to explore 3 of the most dangerous mental traps: the availability trap, these deceptive lookalikes, and our bizarre inability to understand the return to average. And then, we'll get to the most important part. How in the world do we fight back and outsmart our own minds?
You see, that whole shark mistake? That wasn't just a random error. That was your brain's programming working exactly as intended, just in the wrong situation. This system of mental shortcuts is designed to be efficient, but man, can it be dangerous when we misapply it.
Now, there's a fancy name for this stuff: cognitive heuristics. This comes from the Nobel Prize-winning work of 2 geniuses, Daniel Kahneman and Amos Tversky. And here's the thing they figured out that's so important. These shortcuts are not a flaw in our design. They're actually a crucial feature. They're what let you do things like drive a car, listen to the radio, and keep an eye on traffic all at the same time without your brain just melting down. They're usually brilliant.
But, and this is a huge but, the modern stock market is nothing like the ancient world our brains evolved for. So the very same mental programs that help us get through the day end up causing us to completely misjudge the odds when it comes to investing. And that leads to these predictable, repeating, and often very, very costly mistakes. All right, let's dig into our first big trap. It's called the availability heuristic, and it is exactly what tripped us up with the shark example. Basically, our brain judges how likely something is, not based on actual data, but on how easily we can think of an example of it. So what's really driving this trap? Well, it's 2 things. The first is called saliency. That just means a really vivid emotional memory. Like a shark attack feels way more probable than it actually is, just because it leaves such a big impression on us. The second driver is recency. Things that just happened feel more likely to happen again. It's why after a big earthquake, sales of earthquake insurance go through the roof, even though the statistical risk hasn't actually changed one bit.
So how does a seemingly harmless little bias like this play out in the real world of investing? Well, let's take a look at one of the most famous market manias in history, the dot-com bubble. In this case, the availability trap didn't just trick investors, it whipped them into an absolute frenzy, all because of these intoxicating stories of people becoming millionaires overnight.
Okay, just look at this chart. It's wild. It shows the average pop in price on an IPO's very first day of trading. For years, it was pretty modest, maybe 10 or 20%. But then, look at 1999 and early 2000. It explodes to an average of 90%. The stories about these massive gains were everywhere, on the news, in magazines, from your neighbor. This wasn't about fundamentals. It was purely about availability. The stories were recent, they were dramatic, and they made buying any old dot-com stock feel like a sure thing.
And here is the brutal hangover. This chart shows what happened next to the average IPO from that bubble period. A catastrophic 97% collapse from its peak. Those vivid, easy-to-recall memories of fast money completely blinded people to the insane risks they were taking. The stories were available, but the real odds, not so much.
So, the availability trap messes with our sense of probability. This second bias, the representativeness heuristic, well, it hijacks our brain's pattern recognition software. It's our very powerful, but often very flawed instinct to see patterns and draw comparisons even when they're not really there.
To put it simply, our brain loves to slap the same label on situations just because they look kinda similar on the surface. And this makes us put way, way too much importance on a few flimsy similarities while we completely ignore all the other critical factors that actually make the situations totally different.
A perfect and painful example was the stock market crash of 1987. The market took a nosedive, and what did the headlines immediately scream? Is this 1929 all over again? Investors got hooked by this scary but totally superficial comparison. They panicked, they sold everything thinking another Great Depression was right around the corner. But the economy itself, it was nothing like 1929. It was actually still pretty strong. And the investors who looked past the scary chart and saw the differences, they were rewarded big time as the market went on to quadruple over the next 10 years.
And this same bad habit, it also fuels something called the law of small numbers. That's our tendency to make these massive conclusions based on tiny, totally meaningless scraps of data. It's why we chase a mutual fund that had one great year, or why we listen to an analyst who made one lucky call, or why we freak out over a single bad month of economic data.
We spot a tiny little pattern, and we mistakenly think it's the beginning of a whole new world.
And that brings us to our third big mental blind spot, a fundamental truth of statistics that our brains just seem to ignore over and over again: regression to the mean. It's one of the most powerful forces in the financial world, and not getting it is a constant source of error.
Okay, to get this, let's just talk baseball for a second. Imagine a player whose long-term batting average is .300. But for 1 week, he goes on a tear and bats .500. We call that a hot streak. The next week, he can't hit a thing and bats .125. We call that a slump. Our brain gets fooled. It sees the hot streak and thinks, wow, he's a new and improved player. It sees the slump and thinks, oh no, he's lost it. But in reality, both the streak and the slump are just temporary blips. Statistics will always pull him back to his real average.
And if you think that's just for sports, check this out. This chart shows the exact same principle at work in the stock market. You see these wild years with returns over 50% and these devastating years with losses over 40%. Those are the market's hot streaks and its slumps. But when you step back and look at the whole picture, you can see this powerful gravitational pull right back to the long-term average. Extreme results, both good and bad, are almost always temporary.
And if you want a perfect, painful example of people forgetting this rule, look no further than this magazine cover from August 1982. After a long, grinding bear market, this was the cover of a major business magazine. They saw the slump and they projected it forward forever: the death of equities. This was published literally just before the start of one of the greatest bull markets in history. They made the classic mistake. They confused a temporary deviation for a permanent new reality. So, we've laid out the traps: the availability trap, the representativeness trap, and our total blindness to regression to the mean. Now for the big question. What on earth do we do about it? How can we actually build a defense against our own minds?
So how do we fight back? Well, we can boil it all down to 3 really powerful mental guidelines. First up, respect the long-term average. Think of that as the base rate. Don't get seduced or scared off by some recent short-term trend, the case rate. Number 2, actively question the obvious similarities. When everyone is screaming, "This time is just like that other time," your job is to be the skeptic and hunt for the crucial differences. And finally, number 3, be patient. A really sound, smart strategy often isn't recognized by the market right away. You have to give it time to work and not let the short-term noise shake you out of it.
Look, at the end of the day, your brain is always going to try to take these shortcuts. It's just how it's wired. It's what makes it efficient. But the good news is, now you know what to look for. You can catch yourself in the act. So the real question is, now that you know about them, which one of these treacherous shortcuts will you make a conscious effort to question first?
So today, we're going to talk about a conquest, but not the kind you're thinking of, with swords and ships and all that. No. This was a conquest of ideas. This is the story of a small band of academics who, armed with just math and early computers, completely overturned the entire world of finance. They really were conquistadors in tweed jackets. To really get this story, you've got to go back, way back. Picture the 1500s. You have the Spanish conquistadors, and they are obsessed with one thing: El Dorado, a legendary lost city made of pure gold. They were driven by this incredible mix of faith and, let's be honest, pure greed. But we all know how that story ends, right? The city of gold was a myth. They never found it. Okay, remember that. Just tuck that away for a minute.
All right, now let's jump forward about 500 years. A totally new kind of conqueror shows up. And these guys, they're not coming from the military barracks. They're coming from university campuses. Their El Dorado wasn't a city of gold. It was something maybe even more valuable: the secret to consistently beating the stock market. And check out their weapons. They swapped out swords and cannons for things like high-level mathematics and mainframe computers. Their faith? It wasn't religious, but believe me, it was a secular academic faith that was every bit as intense. And that really brings us to the big central question of this whole thing. I mean, these new conquerors, they built an intellectual empire that basically rules finance to this day. But did they actually find the truth? Did they uncover how markets really work? Or, just like those Spanish conquistadors before them, did they just build a new, much more sophisticated myth? A new El Dorado? To figure that out, we have to look at the world they were about to invade.
You see, before our academic heroes stormed the castle, Wall Street was its own little kingdom. It had its own traditions, its own priesthoods, its own deeply held beliefs. It was a world ruled by two major and often clashing religions about how you get rich in the market. On one side, you had the chartists. These were the guys who practiced technical analysis. They were kind of like market fortune tellers. They believed that all those squiggly lines on a stock chart, the history of its price, its trading volume, held secrets that could predict the future. Then on the other side, you had the value hunters. They were all about fundamental analysis. These were the detectives, right? Digging through financial statements, analyzing earnings reports, sales figures, absolutely convinced they could calculate a stock's single true value. For decades, these two camps were basically the law of the land. So the first attack from the academic world, it was aimed right at the heart of the chartists. The professors looked at what the technicians were doing and thought, this isn't science, this is more like reading tea leaves. And they showed up with some serious statistical firepower to prove their point.
This was their cannonball, the random walk hypothesis. Now, the idea had actually been around since 1900 from a French mathematician, but it's beautifully simple. It says that a stock's price movement tomorrow is completely independent of its movement today, or yesterday, or last year. In other words, the market has no memory. If a coin comes up heads 7 times in a row, what are the odds it's heads on the 8th flip? Still 50-50. That's what they said the market was like. Now, you can imagine the technicians, these grizzled veterans from the trading floor, they just laughed this off. They looked at these academics in their tweed jackets and scoffed. They'd pull out their incredibly complex charts with patterns called things like head and shoulders or double bottoms, and they'd say, "Are you kidding me? The future is right here. We can see the trends plain as day."
But the professors, they just kept firing. They unleashed this relentless barrage of data. A guy named Eugene Fama, you're going to hear his name again, he took 5 years of data for all 30 stocks in the Dow Jones average. His finding? Totally random. Other academics ran their own studies and found the exact same thing. The trends the chartists were so proud of just weren't there. They even tested specific charting strategies, and the result was always the same. None of them did any better than if you just bought some stocks and sat on them. And here's the final, beautiful, ironic twist. The technicians were starting to love this new tool, the computer. So the academics took that tool and turned it against them. They programmed a computer to recognize all the classic chart patterns and to trade on them, just like a technician would. They ran it on hundreds of stocks over 5 years. The result? It was a massacre. There was zero, and I mean zero, correlation between the patterns and what the stocks actually did. The first tribe of Old Wall Street had been completely demolished.
Okay, so with the chartist in ruins, the academics turned their cannons towards a much, much bigger target, the fundamental analysts. Now, this was a big deal. This wasn't just some rival tribe. This was the high priesthood of Wall Street. These were the guys managing billions of dollars. This was the gospel, and the academics were about to declare it heresy. Their strategy here was devastatingly simple. They just looked at the score. And the score was, well, it was embarrassing for the pros. Study after study, going all the way back to the Great Depression, told the exact same story. The SEC did a study, Alfred Cowles did a couple, then the Wharton School did a huge one in the 60s, and they all found that the vast majority of professional money managers didn't beat the market. In fact, they often did worse. The so-called experts, the smartest guys in the room, couldn't even keep up with a simple average. So this led the academics to ask a really profound question. Why? Why couldn't the best and brightest on Wall Street do their one job, beat the market? And the answer they came up with was powerful, it was elegant, and it was completely revolutionary. They called it the efficient market hypothesis, or EMH for short. And what it says is this: the market is so incredibly good, so fast at processing information that a stock's current price already reflects everything that is publicly known about that company. Everything. Which means there are no secrets left for an analyst to find. So how does this actually work? Well, the logic is pretty cool when you break it down. Step 1, new information hits the world. Let's say a company has a blockbuster earnings report. That news arrives randomly. You can't predict it. Step 2, literally thousands of hyper-competitive, super smart, rational investors all see that news at the exact same time, and they instantly figure out what it means. And step 3, they all rush to buy the stock. The result is that the price snaps up to its new, correct value almost instantly. The competition is so intense, the market is so efficient, that by the time you or I read about it in the news, the party's already over. The value is already in the price. Now, the theory actually comes in 3 different strengths. Think of it like hot sauce: mild, medium, and hot.
The weak form is basically just the old random walk idea. It says past prices don't matter, which kills technical analysis. The semi-strong form is the big one, the one that really took over. It says all public information is useless for beating the market, which is what kills fundamental analysis. Then you have the strong form, which is the super hot version. It says that even secret, inside information is already reflected in the price. Now, most people thought that was a bit too much, and it's not really widely accepted. So, with Wall Street's old beliefs completely conquered, the academics established their new empire. And of course, every new empire needs a new set of laws. And the new laws of finance weren't going to be built around finding value or spotting trends. They were going to be built around a totally new concept, risk. And that gave us this thing called the Capital Asset Pricing Model, or KPM. And it did something pretty radical. It defined risk as one simple thing: volatility. That's it. Just how much a stock's price jumps around compared to the overall market. And they created a single number to measure this, called beta. So the market as a whole has a beta of 1. If your portfolio has a beta of 1.5, it's 50% more volatile and therefore, under these new rules, 50% more risky. Simple as that. And this changed the entire game. It gave us the idea of risk-adjusted returns. Just look at this example. You've got manager A, who gets a fantastic 15% return, crushing the market's 12%, and manager B only gets 13%. So, in the old world, manager A is the hero, right? Pop the champagne. But wait, in the new empire of efficiency, we have to look at the beta. Manager A took on a ton of extra risk to get that return. His beta was 1.5. But manager B, she got her 13% return while taking less risk than the market. Her beta was only 0.9. According to the new law, manager B is the better investor. It's not just about what you make anymore, it's about the risk you took to make it. The implications of this were just enormous, and they reshaped the world for every single person with a retirement account. The new rules were clear. You cannot beat the market, so it's foolish to even try. All that frantic trading is just making your broker rich. The best thing you can do is just buy a bunch of stocks and hold on for dear life. And anyone who does manage to beat the market, oh, they just got lucky. It won't last. All of this led to one very powerful conclusion. If you can't beat them, join them. And that is the thinking that gave birth to the multi-trillion-dollar index fund industry. So there it was, this new empire of thought. It was logical, it was scientific, it seemed perfect, unbeatable. The academics had built a fortress of data and theory. But, just like in the old Greek myths, even the greatest warrior can have a weakness, an Achilles heel. And this beautiful empire had a fatal flaw. Because here's the thing. If the market is this perfectly rational, perfectly efficient information processing machine, where every price is always right, then how in the world do you explain this? How does a perfect system create the dot-com mania of the late 90s, or the absolute terror of the 2008 financial crisis? How do you get these moments of collective insanity, of wild euphoria followed by gut-wrenching panic? Suddenly, the elegant theory starts to look really, really clumsy when it bumps up against the messy reality of the real world. And that right there, that's the fatal flaw. It's so simple, it's almost hard to believe. In their search for mathematical perfection, the professors assumed that every investor was a perfectly rational, emotionless computer. They built a beautiful model of a world that had no people in it. They completely, totally left human psychology, our greed, our fear, our tendency to follow the herd. They left all of it out of the equation. And once you see that, you can't unsee it. The whole theory starts to spring leaks. It just can't answer the most obvious questions. Why do we have speculative bubbles and terrifying crashes over and over again? The theory says professionals can't beat the market, okay? But it doesn't explain how they manage to underperform it for decades on end. How can entire markets be gripped by euphoria and panic if we're all just rational calculators? And maybe the most damning question of all, how is it that some of the worst financial manias and crashes in history happened after this theory became the official religion on Wall Street? Which, in the end, leaves us right here. The conquistadors in tweed jackets, they gave us a new map of the financial world. It was clean, it was scientific, and it convinced almost everybody. But the evidence is pretty overwhelming that the map is dangerously wrong. It's missing huge uncharted continents of human emotion and irrationality. And so that leaves us with a pretty troubling question, doesn't it? If the official map is flawed, how on earth are we supposed to find our way?
You ever come across an idea that just refuses to die? No matter how much evidence you throw at it, no matter how many times it's proven wrong, it just keeps coming back? Well, today, we're talking about one of the biggest, most stubborn ideas in all of modern finance. And believe me, its story is almost too wild to be true. If you've ever seen Monty Python and the Holy Grail, you know this line. You have to know this line. It's from the Black Knight, right? He gets his arms and legs chopped off in a sword fight, and he's still screaming insults, refusing to give up. It's absolutely hilarious. But you know what? It is the perfect metaphor for what we're about to get into.
All right, so let's lay it out. On one side, you've got our completely dismembered but still defiant knight. And on the other, we have this thing called the efficient market hypothesis, or EMH for short. And just like that knight, this economic theory has taken one devastating blow after another. Yet somehow, it's still standing, still a huge force in the world of finance. So let's properly meet this unkillable theory. How in the world did a single academic idea end up completely conquering modern finance? It's quite a story.
Okay, so the core idea of EMH sounds pretty simple, right? It basically says that financial markets are perfectly rational. All the news, all the data, all the good and the bad about a company, it's all instantly baked into its stock price. So you can't really find some secret undervalued stock, and you can't spot an overvalued one before everyone else does. The bottom line, you can't beat the market.
And look, this wasn't just some dusty old theory sitting in a textbook. Not at all. It had a massive real-world impact. Because if you truly believe you can't beat the market, what do? You join it. Over $1 trillion poured into index funds, funds that don't even try to pick winners. They just buy everything to be the market. So yeah, EMH didn't just influence finance, it completely reshaped it from the ground up.
But then, the theory got its first big wound, a deep one, the stock market crash of 1987. This was a complete catastrophe that, according to the neat, tidy, rational world of the efficient market hypothesis, well, it was basically impossible. It could never happen.
So what caused it? Well, the irony is just incredible. The crash was triggered by a doomsday machine built by the theory's biggest fans. It had three parts that all fed on each other. First, you had portfolio insurance. That's a fancy name for computer programs that would automatically sell futures as the market started to fall. Second, something called index arbitrage, which connected that super-fast futures market directly to the regular old stock market. And third, the gasoline for the fire, insane leverage. We're talking margins as low as 5%, meaning you could control a huge amount of stock with very little cash. Now, this whole contraption was built on one single, critical, and, as it turns out, fatally flawed assumption. The academics who designed all this stuff, they had this mantra, liquidity begets liquidity. They really truly believed that for every seller, a rational buyer would always be there, ready to jump in and buy things as they got cheaper. There would always be a buyer.
They were so wrong. On Black Monday, October 19, 1987, the Dow Jones just cratered. It fell 22.6% in one day, a statistical impossibility, according to their models. Liquidity didn't beget liquidity. It vanished. It just evaporated. The buyers ran for the hills, and that automated selling machine kicked into a death spiral. 'Tis but a scratch? Nope. The theory's first arm had just been lopped clean off.
You'd think a 23% crash in one day would be a pretty good lesson. But nope. A decade later, it all happened again. Only this time, the guys at the center of the storm weren't just followers of the theory. Oh no, they were its high priests. This was the collapse of the hedge fund long-term capital management, or LTCM.
And listen, LTCM was supposed to be the smartest room in the world. It was called the Dream Team of Finance, run by Wall Street legends, and not one but two Nobel Prize-winning economists, Robert Merton and Myron Scholes. These were literally the guys who wrote the book on managing risk. They were seen as untouchable. But they had a huge blind spot, and it was baked right into their EMH-based worldview. See, their models were obsessed with one thing, one definition of risk, volatility, how much prices wiggle up and down. They built these beautiful complex equations to predict it, but they completely ignored the two things that could actually kill them. Leverage, how much money they'd borrowed, and liquidity, whether anyone would actually be there to buy what they needed to sell in a panic.
How much did they ignore it? Well, to start, their leverage was 30 to 1. Let that sink in. For every $1 of their own money, they had borrowed 30. What that means is a tiny little drop of just 3.3% in the value of their assets would wipe out every penny of their capital. Gone.
And when markets around the world started to go haywire in 1998, that's precisely what happened. As they started losing money, their leverage just exploded, going to an almost comical 100 to 1.
At that point, a 1% drop meant bankruptcy. The dream team went completely bust, and the Federal Reserve had to orchestrate a massive bailout to stop them from taking the entire global financial system down with them. Another limb. Gone.
So after two impossible events, surely the lesson was learned. Nope. What came next was the biggest blow of them all, the 2008 global financial crisis. And you know what? It was the exact same story as LTCM. The same flawed ideas about risk, the same insane blindness to leverage and liquidity, but this time, it was playing out on a planetary scale.
To really get a sense of the thinking at the time, you just have to hear this quote. This is from 2007, right as the housing market is about to go off a cliff. It's from Professor Eugene Fama, the literal father of the efficient market hypothesis. He said the word bubble drove him nuts because, markets are rational and people are careful.
And this was the reality. This chart shows a mortgage index that the rating agencies called investment grade. That means it was supposed to be super safe. It didn't just dip a little. It fell 98%. It was basically wiped out. So much for no bubble.
And the reason why was brutally simple. It was the same old story, leverage. Look at this chart. If you're leveraged 30-to-1 on these mortgage bonds and their price drops just 5%, you don't lose 5%. You lose 150% of your money. If they drop 10%, you lose 300%. It wasn't a risk model. It was a weapon of mass financial destruction that turned a housing slump into a global apocalypse.
So, let's step back. After watching 3 supposedly impossible crashes happen, we can pretty clearly see the fatal flaws in this whole idea. Why does this theory keep getting so brutally smacked down by reality?
Well, pretty much every single pillar holding the theory up just got shattered. We learned the hard way that liquidity is not infinite. It completely disappears right when you need it most. We learned investors are not rational robots. They're human, and they panic. Markets can be, and often are, wildly inefficient. And maybe the biggest lesson of all, risk is not just about volatility. The real killers, the things that will actually blow you up, are leverage and liquidity.
Which brings us right back to our friend, the Black Knight. Battered, dismembered, proven wrong by reality again and again and again. And yet, the efficient market hypothesis is still taught in universities. It's still a guiding principle on Wall Street. So the question we have to ask ourselves is, if a theory is this broken, this dangerous, why on earth won't it just die?
So here's a wild thought for you. What if I told you that one of the biggest, most important Nobel Prize-winning theories in all of modern finance is basically built on the same kind of flawed thinking as a scientific mistake that lasted for 1,600 years? Well, today we're going to deconstruct a financial dogma by comparing it to Ptolemy's ancient model of the universe. It's a heck of a story about how some really beautiful ideas, wrapped up in all this complicated math, can sometimes lead us completely off a cliff.
All right, so here's how we're going to break this all down. We're going to kick things off way back in the ancient world with that 1,600-year-old mistake. Then we'll jump to the present and see its modern-day twin in finance. We'll get into this strangely obsession with volatility, look at the shaky proof that turned theory into fact, and then, and this is the important part, we'll see why any of this actually matters in the real world. And finally, we'll ask, when is a new Galileo going to show up for finance?
So our story doesn't start on Wall Street. Nope, it starts in the 2nd century with this absolutely brilliant guy named Ptolemy. He came up with a model of the universe that was so convincing, so useful, that it just completely dominated science for almost 16 centuries. Think about that.
Now, you have to understand, the Ptolemaic system wasn't just some random guess. It was incredibly powerful because it did 2 things that any great scientific theory has to do. First, it was predictive. You could use it to figure out where the planets were going to be, which was absolutely critical for things like sailing. And second, it was explanatory. It gave a complete, logical system for how everything in the sky moved. It just had one tiny little problem with its main idea.
And that right there, that gets to the absolute heart of what we're talking about today. A theory can be elegant, it can be useful, it can be accepted by literally everyone for centuries, and it can still be built on a foundation that's just completely, totally false. Because of course, the Earth is not the center of the universe.
Okay, so let's fast forward a couple thousand years and see this exact same pattern play out in a totally different world. Let's pivot from the stars to the stock market, because finance has its own version of this story. It's a theory that became every bit as dominant in its field, the efficient market hypothesis.
You know, at its core, the efficient market hypothesis, or EMH, is a really beautiful idea. It basically says that you've got thousands and thousands of super smart, rational investors out there, all analyzing every scrap of information. And because of all their buying and selling, stock prices are always perfectly priced. They reflect their true value at all times. In a market like that, there are no bargains, no free lunches. You can't consistently beat the market because, well, the market is perfect. Okay, so if the market is this perfect, rational machine, how does a theory like that deal with something as messy and human as risk? Well, this is where it gets really interesting and where the parallels to Ptolemy start to get kind of spooky. The theory needed a simple, clean, measurable way to define what risk is.
And the answer is almost embarrassingly simple. They did it because it was easy. Volatility, how much a stock's price bounces up and down, is super easy to measure. It gave them a nice, clean number to plug into the elegant computer models they were building. They didn't really go out and check if actual real-life investors thought about risk this way. They just kind of declared it to be true because it made the math work.
So this obsession with volatility gave birth to this thing called beta. Beta was supposed to be this magical single number that told you everything you needed to know about how risky a stock was. If a stock had a high beta, it was volatile, which meant it was risky, and therefore, and this is the key part, the theory said it had to give you a higher return to pay you back for taking on that risk. It became the absolute bedrock of how finance measured risk. But then, the plot twist. And oh man, it is a stunner. In 1992, the guy who created the efficient market hypothesis in the first place, Professor Eugene Fama, he publishes this research that just drives a stake right through the heart of beta. Can you imagine? After decades of this being taught as gospel in every business school, the creator himself basically says, yeah, you know that thing? It doesn't work.
I mean, Fama and his partner Kenneth French, they looked at almost 10,000 stocks over a nearly 30-year period, and their conclusion was crystal clear. There was no link, none, no reliable connection between a stock's beta and how it actually performed. The high volatility stocks did no better than the low volatility ones. The central pillar of risk in modern finance was, well, as one magazine put it, it was just bogus.
So this brings up a massive question, right? If the main tool the theory used to measure risk was totally broken, how on earth did EMH become the law of the land in finance for half a century? How did it get treated like a fact?
Well, the main evidence, the proof, it all came from these studies back in the 60s and 70s. And what they did was look at the performance of professional mutual fund managers. And they found that, as a group, these pros couldn't beat the market averages. And that was it. That was held up as the definitive proof that the market was perfectly efficient.
But, and this is a huge but, when you dig into how they actually ran those studies, the methods they used were, let's just say they were a little shaky. The bar they set for success was so high it was practically impossible. To prove you weren't just getting lucky, a manager had to beat the market by almost 6% every single year for 14 years in a row. I mean, a manager who brilliantly outperformed by 2% a year for 20 years wouldn't even show up as being statistically significant. The tests were so weak, they couldn't spot even amazing performance.
And this is where we get right back to Ptolemy. Just like his followers had to invent these extra little circles called epicycles to explain away planets that weren't behaving, the EMH guys had to deal with what they called anomalies. These were just facts from the real world that totally contradicted the theory. For instance, it's a known fact that stocks with low price-to-earnings ratios tend to do better over time. Their theory's explanation? Oh, well, they must just be riskier in some way we haven't figured out how to measure yet. It's an answer they invented just to save the theory from the facts.
Now, I know what you might be thinking. This all sounds like a bunch of professors arguing in an ivory tower, but it's not. These ideas escaped the university, and they had massive, real-world consequences that have affected pretty much all of us.
I mean, think about it. This broken idea about risk decided how trillions with a T, trillions of dollars in pension funds and retirement accounts were invested. It told big companies that they didn't need to keep much cash on hand, making them way more fragile. It pushed CEOs to make bad investment decisions based on these faulty calculations. And yeah, it played a really big part in making the 2008 financial crisis even worse by giving everyone this false sense of security about how they were managing risk.
So why did so many smart people buy into it? The Nobel Prize winner Paul Krugman just nails it. He said the problem was that the theory was just beautiful. The math was so elegant, so impressive, it looked and felt like the truth. But the basic assumptions that all investors are rational and that risk is just volatility, they didn't really have a strong connection to how the world actually works.
So, if the big dominant theory is broken, where do we go from here? What does the history of science teach us about what happens when a powerful idea that's been around forever starts to crumble?
Well, the parallel is just striking. It's so direct. When Galileo's telescope showed him moons orbiting Jupiter, which went against the idea that everything orbits the Earth, astronomers didn't just throw out the old theory. Nope, they just added more epicycles to try and make it fit. It's the exact same thing in finance. When the market crashes or some anomaly keeps popping up, the defenders don't ditch the theory. They just add new factors, like a value factor or a size factor, to try and patch up the holes.
The historian of science Thomas Kuhn actually had a name for this whole process. He called it a paradigm shift. And it's not some gentle, slow evolution. It's a revolution. It's what happens when the old theory just gets so weighed down with patches and fixes that it finally collapses and a new, better idea takes over. But let me tell you, that process is never easy.
As the economist Paul Samuelson once famously joked, old ideas die hard. The people who believe in them have built their entire careers, their whole reputations on that old idea. They're going to defend it to the bitter end, because to reject it is to reject their life's work. A lot of the time, real change only happens when a whole new generation comes along. So when you boil it all down, when you strip away the decades of academic papers and all the complicated math, the evidence points to a conclusion that is just as shocking to modern finance as Galileo's discovery was to the church back in the 17th century. It basically challenges the center of their entire universe.
And that leaves us with one last big thought to chew on. This story, it isn't really just about finance, is it? It's a powerful reminder to always, always question the elegant theories and the accepted wisdom that we're told is just fact. Because history shows us time and time again that yesterday's universal truth is often tomorrow's quaint, old, and flawed idea. The question for us is, what are we clinging to today that people in the future are going to look back on and just shake their heads?
All right, let's talk about something huge on Wall Street, forecasting. I mean, it's everywhere, right? It's the engine that drives pretty much every investment decision, the very foundation of thousands of research reports. But what if that foundation is built on sand? Today, we're going to dig into why Wall Street's obsession with predicting the future so often leads regular investors down the wrong path.
You know, way back during the Great Depression, Woody Guthrie had this incredible line. He's saying that a simple fountain pen in the right hands could be just as dangerous as a loaded gun. It was this perfect, powerful symbol for how finance could bring people to ruin back then, and honestly, it sets the perfect tone for what we're about to uncover today.
And that really brings us to the big mystery, doesn't it? We've traded those old fountain pens for supercomputers and oceans of data. The tools are, infinitely more powerful, and yet the financial world is still just littered with these spectacularly wrong predictions. So, what is going on here? How is it possible that the experts, with all this technology at their fingertips, still miss the mark by a mile? That's the question we're here to answer.
To really get to the bottom of this, we have to start with the one tool that's used in every single analysis, no matter how fancy the spreadsheet is. And our prime suspect? It's not the technology, it's the person using it. It's the human brain. So to understand the crime, we have to profile the suspect. And that means getting into exactly how our minds process information.
Okay, so there's a name for the specific skill you supposedly need for great financial forecasting. It's called configural reasoning. And what's wild is how it works. See, it's not about looking at one thing at a time. It's about seeing how dozens of different things like earnings, industry trends, interest rates, what the competition is doing, how they all bounce off each other and change each other's importance all at the same time. It really is like juggling. You add one more ball to the mix and the whole thing gets exponentially harder.
Let me put it another way. Our brains, they're amazing at linear thinking. That's like following a recipe, right? Step 1, then step 2, then step 3. It's straightforward, it's logical. But financial analysis, that demands configural thinking. It's much more like a master chef who can taste a sauce and just know instantly that one extra drop of vinegar will change the entire flavor profile. One tiny change affects the whole system. And that's where we humans really start to have a tough time.
So, this is the crucial question, isn't it? We know investing needs this super complex, interactive way of thinking. But just because it's needed doesn't mean we're actually any good at it. So how well do trained professionals really use this skill when it actually counts? The hard data on this? Well, it might just shock you.
In one huge study, researchers looked at radiologists. These are doctors diagnosing malignant ulcers. We're talking life or death decisions here that require them to weigh 7 different factors at once. The task is totally configurable. No one factor tells the whole story. It's the combination that matters. So the result? How much of this complex interactive reasoning do they actually use in their final decisions? A measly 3%. The other 97% of their thinking was just simple, one thing at a time, linear processing.
And just in case you're thinking, well, that's a medical thing, they ran a similar study with stockbrokers. They gave them 8 key financial data points to analyze companies. And the amount of configural reasoning they actually used? 4%. It's practically identical. In the very field where this complex skill should be king, it's barely even being used. So this leads us to a conclusion that's pretty hard to ignore. The most fundamental tool in this whole business, the human mind, is basically a single-task machine trying to solve a multitasking problem. We just aren't built, we're not hardwired, to do the kind of intricate, multivariable juggling that modern finance is built on.
But look, a faulty tool is only part of the story. Things get a whole lot worse when we introduce an accomplice to the crime, this deep-seated belief that just getting more information will fix the problem. This leads us straight into what's called the overconfidence trap, a really powerful and dangerous force.
I mean, it's perfectly logical, right? It just makes sense that the more data you have, more reports, more numbers, more expert opinions, the better your final decision is going to be. It just feels right. The only problem is, when psychologists have actually studied this, they found a pattern that is completely counterintuitive and, frankly, pretty disturbing.
And this chart illustrates the problem perfectly. As you give an expert more and more pieces of information, their confidence in their own judgment just skyrockets. They feel more and more certain that they've got it right. But their actual accuracy, it barely budges. It just stays stubbornly, dangerously flat. And that growing gap between how right they feel and how right they are, that's where the big mistakes happen.
And this isn't just a finance thing. It's a human thing. Researchers gave clinical psychologists 4 times the amount of information about their patients. Their accuracy went up by a tiny 2%, but their confidence went through the roof. They did the same thing with veteran racetrack handicappers. Giving them more data made them way more confident in the horses they picked, but it didn't help them pick any more winners.
This quote just nails it, doesn't it? The overconfidence trap creates this bizarre world where experts are absolutely certain about predictions that are fundamentally flawed. The more complex it gets, the more information they want, and the more certain they become, even while their actual odds of being right stay low.
So now let's take these 2 psychological flaws, our brain's limits and our tendency to get overconfident, and let's bring them to the scene of the crime, Wall Street itself. Because here, these 2 biases combine to create this widespread, incredibly expensive thing called the optimism virus.
Okay, it's time to look at the cold, hard evidence. The entire system of valuing stocks is built on one thing: forecasting how much money a company will make in the future. Trillions of dollars shift based on these predictions. So, what's the smoking gun? Just how accurate are these all-important forecasts from the top analysts on the planet?
81%. Let that sink in for a second. That is the average annual percentage error for Wall Street analysts' earnings forecasts over a period of almost 20 years. Not 8%, not 18%, 81%. That is a mind-boggling level of wrong for the single most important number in all of finance.
And right here, you can see the raw data. Year after year, from '88 to 2006, through booms and busts, the pattern is exactly the same. On average, analysts predicted 21% earnings growth. What actually happened? Just 12%. See, this isn't just a random error. It is a consistent, powerful, optimistic bias. The source material for this explainer calls it a lethal financial virus, and you can see why.
Okay, so their earnings forecasts are wildly optimistic. We've established that. But what about their actual stock picks? Does all that research at least lead them to pick stocks that win? Let's zoom out a bit and look at the long-term track record here. Is this a new problem, or is this a chronic pattern of behavior?
This chart gives you the answer in one devastating picture. Across dozens of surveys spanning more than 60 years, when big groups of financial experts picked their absolute favorite stocks for the coming year, those stocks went on to underperform the market average 3/4 of the time. Just think about that. 3 times out of 4, you would have been better off just ignoring them completely.
And here is the historical proof. This isn't one bad decade. We're talking from the roaring 20s all the way to the 90s. The pattern just holds true. The data, pulled from places like the Wall Street Journal and Business Week, all points to the same damning conclusion. The consensus best ideas from the pros are, with shocking consistency, losing ideas.
So the verdict from our little investigation is in. The combination of our brain's limits, our slide into overconfidence, and this pervasive optimism bias creates a system where expert financial forecasting is just fundamentally unreliable. So what can you, the individual investor, do about it? Let's shift gears from the problem to the solution and talk about building your defense.
So how can you protect yourself from all this? This slide lays out 4 really practical guidelines. Number 1, you have to accept that more information does not equal more profit. It's usually just a confidence trap. 2, be super skeptical of patterns and correlations. They have a nasty habit of vanishing the second you put real money on them. 3, whenever you see an analyst's forecast, just automatically slash it. Build in your own reality check and adjust their optimism down. And finally, just tread carefully. Recognize how incredibly difficult this game is. Most conventional methods are asking way too much of our brains.
And we'll end here. Look, the point of all this isn't to say that financial pros are bad people. It's to show that they're human. They are subject to the very same cognitive biases and mental limits as you and me. The data proves it. So knowing that the illusion of expertise is so powerful and so common, the final question is one you have to answer for yourself. Who are you ultimately going to trust with your financial future? Thanks for joining me.
You know the scene, right? You flip on the TV in the morning and there he is, the perfectly dressed financial analyst looking you right in the eye, telling you with absolute certainty where the market is headed. They're presented as these modern-day oracles, and when they speak, people listen. Billions of dollars move. But what if they're just wrong? Not just a little wrong, but consistently, wildly wrong. Today, we're going to find out.
And I mean, we really do treat their words like gospel, don't we? An analyst upgrades a stock from a hold to a buy, and the price just takes off. They downgrade one, and boom, billions in market value can vanish in an instant. These really are the showstoppers. They're the moments that can define a company's year, make or break a portfolio, all based on the judgment of one person who we're told has it all figured out.
That's the multi-trillion-dollar question, isn't it? We give these forecasts so much power. We build entire investment strategies around them. But what happens if that entire foundation is built on sand? What if the crystal ball is, well, just a snow globe? We're going to pull back the curtain and really look at the numbers. Are we getting expert analysis, or is it something a lot closer to a high-stakes guessing game?
To really get what's happening today, you gotta look back at the past. And there is no better, crazier place to start than the dot-com bubble of the late 90s. This was a time when analysts were treated like rock stars, and the so-called Chinese walls that were supposed to separate research from banking, well, they didn't just crack, they were completely bulldozed. So just look at this timeline. It's the perfect storm of greed and conflict of interest. You had guys like Jack Grubman, a huge telecom analyst. His pay was so obscene that his own colleagues joked about pricing deals in $2.5 million Grubman units. So he's publicly down on AT&T. But then his boss at Citigroup, the CEO Sandy Weil, suggests he take another look. Lo and behold, Grubman upgrades the stock to a buy. And what happens right after? Citigroup just happens to collect a cool $63 million in fees from AT&T. This was the game. The analysts weren't working for you, the investor. They were the sales team for the investment banking division.
And this quote from the SEC investigations just lays bare how cynical the whole thing was. It's almost hard to believe. Publicly, they're on TV telling Main Street investors to load up on these shaky internet companies, calling them screaming buys. But privately, in emails to their big money clients, they're calling these same stocks pigs and junk. The famous case was Merrill Lynch analyst Henry Blodgett. He had a strong buy on a stock, but when a huge client emailed him asking what was so good about it, his honest answer was nothing. Nothing interesting, that is, except for the massive banking fees his firm was about to make. The level of deception was just staggering.
Okay, so it's really easy to look back at the dot-com era and just write it off. You know, that was a wild time, a complete one-off, it could never happen again. But was it really an anomaly? Or was that whole scandal just the most obvious symptom of a much deeper, more fundamental problem with forecasting itself? To answer that, we have to stop talking about scandals and start looking at the cold, hard data.
All right, let's really dig into this chart, because this is where it gets fascinating. This is not some small cherry-picked study. We're talking about 38 years of data. 38 years. It covers almost 1 million individual analyst estimates. Each one of these bars shows the average forecast error for that year. Basically, how far off the consensus estimate was from what the company actually earned. And I mean, you don't have to be a statistician to look at this and see. These aren't small misses. These are huge.
So here's the bottom line.
Over that entire 38-year period, the average annual error was a whopping 40%. Just let that sink in for a second. Not 4%, 40. Now you have to understand, professional investors will tell you that a miss of just 3%, what they call an earnings surprise, is enough to send a stock price reeling. So an average error that is 13 times that size, it just completely overwhelms any attempt to figure out what a company is actually worth.
But okay, let's be generous. Let's give them some wiggle room. Maybe judging by one big average number isn't totally fair. Let's ask a different question. How often do they even get close? Most pros would say that for a forecast to be even remotely useful, it has to be within, say, plus or minus 5% of the real number. Any wider than that, and it's basically a guess. So how often do these experts hit that pretty wide target?
They miss it more than 70% of the time. Let me say that again. More than 7 out of 10 times, the consensus forecast is not within that generous plus or minus 5% range. I mean, think about it this way. If your local weather forecaster was wrong more than 70% of the time, would you even bother checking the weather before you left the house? Of course not. And yet, in the financial world, we've built a multi-trillion-dollar industry on top of this exact level of performance. Now, I know what you might be thinking. Okay, fine, but that huge error rate must be coming from crazy, unpredictable tech startups or biotech companies. Surely they're much better at forecasting big, stable, predictable industries, right? It's a fair question, and luckily the data lets us answer that too. This table breaks down the average forecast error across 24 different industries. The results are just wow. The errors are everywhere. It's indiscriminate. The media industry, a staggering 49% average error. But look at something like technology hardware. These are huge, well-covered companies. Still, a 35% error. How about pharma and biotech, where you have these long, predictable product pipelines? Nope. 31% error. There are no safe havens. This idea that you can pay a premium for a stock because its earnings are more predictable is a complete myth. The data just blows it out of the water.
So by now, we've clearly established the what. The forecasts are consistently, dramatically, and universally wrong. So the next logical question is, why? Are these highly paid experts just bad at their jobs, or is there something bigger going on here? Turns out it's a powerful cocktail of human psychology and some really messed up institutional pressures that make being accurate almost impossible.
You can thank the brilliant psychologist Daniel Kahneman for this idea. See, analysts almost always use what he calls the inside view. They get totally obsessed with the unique story of one company, its amazing CEO, its game-changing new product, its huge market, and this focus makes them wildly overconfident. They start to believe that this time it's different. The outside view, on the other hand, is the total opposite. It ignores the story and just asks a cold statistical question. Historically, when companies were in this exact situation, what percentage of them actually succeeded? It's a much more boring, but as we're seeing, a much more realistic way to look at the world.
And here, folks, is the smoking gun. This is where it all comes together. What do you think analysts are actually paid to do? You'd think being accurate with their forecast would be number one on the list, right? Well, it's not. In fact, look where it is. It's dead last, number 7. So what's number 1? How they're rated by their own firm's sales force. In other words, how good are they at drumming up trading commissions? Number 2 is getting on the all-star team, which brings in prestige and tons of money for the firm. Generating investment banking deals is way up there too. Being right? It's practically an afterthought. The incentive isn't to be accurate, it's to be a great salesperson.
Okay, we've seen the scandals. We've looked at decades of shockingly inaccurate data. We've uncovered the flawed psychology and the warped incentives. So now it's time for the verdict. Let's put all of this together and translate these constant forecasting failures into the actual mind-bending odds that you, the investor, are up against every time you bet on an analyst's call.
This right here, this table, is the final nail in the coffin. It shows the probability of a company's earnings staying inside that crucial plus or minus 5% range quarter after quarter after quarter. Remember, that's the whole game for growth investors. They're paying for consistency and predictability. But as you're about to see, the odds of that actually happening over any meaningful period of time are, well, let's just say they're not good.
Let's start small. For just 4 quarters in a row, a single year, the odds that a company's earnings will land inside that forecast range every single time are just 1 in 132. Not great odds for sure, but maybe you'd roll the dice on that. It's just 1 year, right?
But what about 10 quarters? Just 2.5 years. What happens to the odds then? They don't just get worse, they fall off a cliff. The odds plummet to 1 in 199,000.
All of a sudden, we have left the realm of investing and have entered the world of lottery tickets. The chances of that beautiful, smooth, predictable earnings growth just melt away.
And now for the grand finale. What about 20 quarters in a row? Just 5 years. The odds drop to a number that is so staggering it's hard to even comprehend. 1 in 40 times billion. Let me put that in perspective for you. Your odds of winning the Powerball lottery are literally hundreds of times better than that. It is fundamentally, statistically impossible. People are staking their life savings on a bet that is objectively worse than a $2 lotto ticket. It's absolute madness. Okay, so we've established that relying on these precise forecasts is a long shot of truly epic proportions. It's a loser's game. So what's the takeaway? Do we just give up? No, absolutely not. The answer is to stop playing their game and to start playing a smarter one. It's about adopting a new mental model for investing, one that's actually based in reality.
So here it is, your new toolkit. First, and this is the big one, you just have to accept it deep in your bones. Precise long-term earnings forecasts are a statistical fantasy. They don't exist. Second, that means you should be incredibly wary of any investment strategy that needs that kind of impossible accuracy to work. If it sounds too good to be true, it is. Third, start using the outside view. Instead of getting sucked into a great story about one company, ask about the base rates. How many companies like this have actually succeeded in the past? And finally, be a hardcore realist, maybe even a pessimist about the downside. Whatever management says is the worst-case scenario, assume the reality could be much, much worse.
And that's really the question I want to leave you with. We've just spent this whole time proving that the game most people think they're playing, a game of skill, of expertise, of predictability, is actually just a lottery with the worst odds imaginable. And just knowing that, truly understanding that, is the most important first step. The next step, the one that really matters, is for you to decide. If you're not going to play that game anymore, what smarter, more durable game are you going to play with your future?
Welcome to The Explainer. Today we're diving into a real head-scratcher in the world of investing, something that pretty much turns what we think of as common sense completely on its head.
Yeah, you heard that right. It's a question that really challenges a core belief that, most of us have. That great companies, the ones with all the buzz and the exciting stories, are always the best investments. But you know what? The data tells a very, very different story.
To really get this, we have to appreciate the raw power of surprise itself. Just look at history. It's absolutely packed with moments where a sudden, shocking event triggers a massive, almost predictable overreaction. Think about the sinking of the Lusitania, the attack on Pearl Harbor, or the Gulf of Tonkin incident. These were shocks to the system that just shattered the way things were. And that exact same dynamic, it plays out on Wall Street every single day.
Market surprises follow these same predictable patterns of overreaction. Sometimes they disillusion millions, like the Enron collapse or that crazy flash crash in 2010. But, and this is the important part, they can also create unbelievable opportunities for people who know what to look for. Understanding how all this works is absolutely crucial if you want to be a smarter investor.
Okay, let's really get into it. To solve this puzzle, first we need to get our heads around how the market splits stocks into two camps. And it's not based on how good the company is, it's all about what investors expect from them.
So, on one side, you've got your favored stocks. These are the darlings of Wall Street, right? The companies with the great stories, the ones everyone thinks have the brightest futures, hopes are super high, and people are willing to pay top dollar for them. That's why they have high PE ratios. And then, you've got the unfavored stocks. These are kind of the dogs of the market, the ones with bleak outlooks that nobody really wants to touch. Expectations for these guys are in the basement. Now here's the kicker. For both of these groups, investors are super confident in their predictions. So what do you think happens when a surprise comes along and just blows that confidence to smithereens? Well, the data is pretty shocking.
Okay, take a look at this. This chart comes from a massive 38-year study, and it shows us exactly what happens. Just focus on those bars on the right. That's the full year performance. The dark bar, those are the unfavored stocks, the ones nobody liked. On average, they beat the market by 3.8% a year. Now look at the white bar, the favored stocks. They actually underperform by 3.2%. You add that up, and it's a 7% performance gap. It's wild. The simple truth is, surprise systematically helps the stocks nobody believes in and hurts the ones everyone adores.
But here's where it gets even crazier. Let's just look at the positive surprises, the good news. For the favorite stocks, the white bar, good news barely moves the needle. It was already expected, right? So who cares? But for the unfavored stocks, that dark bar, good news is like a lightning bolt. Because expectations were so incredibly low,
A positive surprise forces everyone to completely rethink the stock, and it sends them soaring 6.7% above the market for the year.
And this is the other side of that coin, and it perfectly shows the danger of high expectations. When we look at negative surprises, the unfavored stocks, that dark bar, they barely even flinch. I mean, bad news was already baked into the price. But for the favored stocks, the white bar, a negative surprise is absolutely catastrophic. It shatters that whole illusion of perfection, and they end up underperforming the market by a shocking 9.4% a year. People paid a premium for growth and certainty, and when they don't get it, they run for the hills.
So, we've seen the what, but now we got to get to the why. And the key to this whole thing is realizing that not all surprises are the same. They actually fall into two totally distinct psychological buckets, and this difference, well, it unlocks the entire puzzle.
Okay, the first and most powerful type is what we call an event trigger. This is a surprise that completely shatters a belief that people held. It's that unexpected bit of great news for that boring, forgotten company, or it's the shocking bad news for that high-flying market darling. It literally forces investors to change their entire perspective, and that leads to a huge price correction.
And then there's the second type, the reinforcing event. This is a surprise that just confirms what everybody already thought. Good news for a favorite stock? Well, yeah, of course, it's a great company. Bad news for an unfavored stock? Well, what else did you expect? Because these events don't change anyone's mind, they have a way smaller impact on the stock price.
And the difference between these two, look at this, it is absolutely staggering. This chart just looks at the raw market impact. On the right side, for the full year, you see that event triggers, those belief-shattering surprises, have a massive 14.1% impact on a stock's price, and reinforcing events, a measly 0.6%. That is not a typo. The surprises that change our minds are over 23 times more powerful than the ones that just pat us on the back for being right. This right here is what really moves the needle.
But why? Why does this happen? Why do we react so powerfully to one kind of surprise and just shrug off the other? Well, the answer isn't in some dusty old finance textbook. It's actually in the wiring of our own brains.
There's this incredible field called neuroeconomics that gives us a really powerful explanation. By using stuff like brain scans, it shows us what's literally happening inside our heads when we make decisions. And it turns out, it all comes down to one tiny but very powerful chemical.
That chemical is dopamine, and it's the key to our brain's reward system. But here's the really crucial part. The system isn't really about the reward itself. It's all about the prediction. So, if you expect something good to happen and it does, you get a normal shot of dopamine. Fine. But if something happens that's even better than you predicted, that's when your brain unleashes a huge surge of the stuff and you feel great. And on the flip side, if the outcome is worse than you predicted, the dopamine faucet shuts off and you feel that sting of disappointment. This simple little formula from neuroscience, it perfectly explains every single chart we've just looked at. Our emotional and, by extension, our financial reaction is all about the gap between what we expect and what actually happens. Think about it. Good news for a favorite stock? Well, the reward happened, but it was already predicted. Dopamine response is tiny, stock barely moves. But good news for an unfavored stock, a reward happened when something bad was predicted. The result is a massive dopamine rush in your brain and a massive surge in the stock price. It's that simple.
Okay, so what does all this mean for you as an investor? Let's pull all this together into a clear set of principles you can actually use. Because this isn't just some cool theory, this stuff translates into a real, tangible edge in the market.
So, here are 4 clear guidelines, all backed by data. First, surprises consistently help the underdogs and hurt the darlings. Second, good news is a huge deal for unfavored stocks, but means almost nothing to the favorites. Third, bad news is absolutely devastating for favorites, but it's a total non-event for the unfavored stocks. And finally, and this is so important, these effects are not just a one-day thing. And if you think this is just a quick blip, check out this last chart. It shows just how long-lasting these effects are. We're tracking performance for 5 full years after the surprise. Look at that top line. That's the unfavored stocks that got good news. They just keep outperforming quarter after quarter. And that bottom line, the favorites with bad news, they just keep bleeding out. It just goes to show you the market is really slow to change its mind, and that creates a window of opportunity that can last for years. And when you add it all up, the total performance gap between those two groups, the absolute best case scenario and the absolute worst case, is a staggering 60.7% over 5 years. That is the massive long-term price of overconfidence, and it's the reward for understanding how psychology really drives the market.
Look, the evidence is pretty clear. By understanding our own biases, by recognizing that the market is really all about the gap between expectation and reality, we absolutely can. By looking at the stocks that everyone else has written off and being just a little bit skeptical of the ones everyone says are a sure thing, you can start to harness the incredible power of surprise instead of just being a victim of it.
You know, it was supposed to be a coronation, a perfect season, capped by a championship. The story, well, it was basically already written.
I mean, everybody agreed. The bookies, the sportscasters, the fans. The Boston Globe was even pre-selling a book on Amazon called 19-0, the historic champion season of New England's unbeatable Patriots. Talk about confidence.
And that simple fact, that they were completely wrong, holds a really powerful lesson. Not just for sports fans, but for anyone out there trying to build some real wealth.
Okay, so picture this. Super Bowl 42. The undefeated New England Patriots are up against the New York Giants, a team that pretty much just scraped its way into the playoffs. The odds? They favored the Patriots by a staggering 17 points. But then, with just 35 seconds left on the clock, the unthinkable happened. The Giants scored the game-winning touchdown. That inevitable victory? Poof, it just vanished. The unbeatable team was beaten.
So what if that exact same dynamic plays out in the stock market? What if the companies that everyone's betting on, the ones with the perfect stories and sky-high expectations, what if they're actually the ones destined to disappoint? And what if the real winners are the ones nobody even sees coming? Well, this gets us to a really fundamental mismatch in the market. See, just like in sports, the crowd's favorite is often a terrible bet. The stocks that the so-called experts and all the money managers absolutely love, the ones with all the buzz, well, they consistently get punished by reality.
Think about it like this. On one side, you've got the favored stocks. They are priced for absolute perfection. All that investor enthusiasm bakes in years and years of flawless growth, which makes them incredibly expensive. And then, on the other side, you've got the out-of-favored stocks. They're neglected, they're overlooked, and because of that, well, they're often just sitting there in the bargain basement priced for perpetual failure.
Okay, so here's the real heart of the issue. Predicting the future with perfect accuracy is, let's be honest, it's pretty much impossible. So when those rosy forecasts for a favorite stock inevitably miss the mark, even by just a tiny bit, the punishment is swift and it is severe. But on the flip side, when an underdog company simply doesn't fail, when it manages to produce even a small positive surprise, investors are forced to reevaluate, and that stock gets a powerful second look. Now here's the crucial psychological insight. The market, it eventually figures this mismatch out, but it doesn't happen overnight. This whole reevaluation process can be slow, I mean glacially slow, and that slow, predictable process is the key to consistent, long-term profits.
So, if the goal is to bet against the crowd, how do you actually find these underdogs? Well, fortunately, there's a proven playbook, and it doesn't require a crystal ball or some complex algorithm, just a few simple, really powerful metrics.
These are the 4 key tools in the Contrarian's playbook. You look for companies with low price-to-earnings ratios, which just means you aren't overpaying for their current profits. You find businesses with low price-to-cash flow, which shows they're generating real, actual cash. You invest in companies with a low price-to-book value. You're essentially buying their assets for less than they're worth. And finally, you look for a high dividend yield, where the company literally pays you to wait for the market to recognize its true value.
Now, I know what you're thinking. This all sounds great in theory, but does it actually work in the real world? Well, the scoreboard never lies. Let's take a look at the decades of hard data that prove the power of this underdog approach.
And listen, this isn't some new idea. This chart here shows a pioneer study from Francis Nicholson that covers the period from 1937 all the way to 1962. And what this early study found was just stunning in its consistency. See, the stocks were divided into 5 groups, from the highest PE, those are the most favored, on the far left, to the lowest PE, the underdogs, on the far right. And look, over 1 year, 3 years, 5, 7, the pattern is undeniable. The cheapest stocks, the ones nobody wanted, delivered the best returns. The lowest group averaged 16% annually, while the most expensive favorites only managed to measly 3%.
But here's the crazy part. For decades, the financial establishment, led by the high priests of the so-called efficient market hypothesis, they basically said this couldn't be happening. They argued these kinds of results were impossible, because the market was perfectly rational and efficient. So this contrarian research, it was dismissed, attacked, and basically left in academic purgatory just because it didn't fit their neat little theory.
But you know what? Facts don't really care about theories. This chart brings us into the modern era. It tracks what would have happened to a $10,000 investment from 1970 all the way to 2010. That solid line at the bottom marked E, that's the overall market. The 4 lines soaring above it, those are the 4 underdog strategies we just talked about: low PE, low PBV, low PCF, and high yield. The result is just staggering. All 4 strategies didn't just beat the market, they absolutely crushed it.
Let's just pull out the most stunning number from that last chart for a second. That initial $10,000, if you had invested it in the cheapest bucket of stocks based on their price-to-earnings ratio, it would have grown to over $3.2 million. To put that in perspective, the same 10 grand in the general market would have become just $913,000. That is the incredible power of betting on the underdog.
And of course, the exact opposite was true for the market's so-called favorites. This chart shows what happened to the most expensive stocks according to those very same metrics. Just look at this. Not a single one of them even managed to keep pace with the market average, which is that top line A. They all dramatically underperformed over the long haul. It's not even close. So let's put this in the simplest possible terms. When you lay the numbers side by side, the performance gap is it's breathtaking. The underdogs turned 10 grand into over 3 million. The market average turned it into just under 1 million. And the favorites, they turned it into a paltry $259,000. We're talking about a 13-fold difference between betting on the underdog and betting on the favorite.
Okay, so racking up huge returns is great. But I know what a lot of you are thinking. Most of us care just as much about not losing money. So a fair question is, how do these underdog stocks hold up when the market starts to fall?
Let's go right back to our sports metaphor. Offense sells tickets, but defense wins championships. A great investment strategy has to do more than just score big points in the good times, and has to protect your capital when the bear market growls.
And the data on defense is just as clear. These 2 charts show what happens in down markets between 1970 and 2010. On the left, we've got the underdog value stocks. While the market dropped an average of 7.6%, every single one of the value strategies fell less. The high-yield stocks were the best defenders, falling only about half as much as the market. Now look to the right. The favored growth stocks, they got absolutely hammered, falling significantly more than the market average. They play great offense, sure, but terrible defense.
So we've seen that betting on the underdog wins big on offense and it holds the line on defense. How do we actually put this championship strategy to work for ourselves?
It really all comes down to this one final, actionable guideline. The playbook is simple. Buy solid companies that are currently unpopular. And you measure that unpopularity using the simple metrics we've seen proven over and over and over again.
And this, of course, leads to the obvious question. If the evidence is so overwhelming, why isn't everyone a contrarian? The answer is pure psychology. Our emotions are an incredibly powerful force. We're captivated by the hot new concept, the exciting story, the lure of hitting a home run. It's just far more thrilling than buying a solid, boring company that's been temporarily forgotten about.
And really, that's what it all boils down to. It's easy to bet on the team with a perfect record and the cheering crowds. It feels safe, it feels smart. But as the data shows, over the long run, the real winners aren't the media darlings. They're the underdogs. So the question you really have to ask yourself is this. In your own portfolio, are you betting on the favorite or are you betting on the champion?
All right, welcome. Today, we're going to dig into an investment philosophy that is incredibly powerful, totally backed by data, and honestly, it flips everything you think you know about the market right on its head. We're going to see why following the crowd can be a huge mistake and how a little bit of independent thinking can give you a massive edge. So, let me just kick this off with a question for you. What if the stocks that everyone loves, the ones on the front page, the ones your neighbor is bragging about, what if those are actually the most dangerous things you could own? I know, it sounds completely backward, but stick with me because the proof we're about to walk through is, well, it's pretty staggering.
Okay, let's get right into it. The whole idea here is built on one single massive mistake that countless investors make day in and day out. And the fascinating part is, it has nothing to do with being smart or dumb. It's all about our own, very predictable human wiring.
And this really lays out the 2 sides of the coin. You know, on one side, you've got the crowd. They're all chasing the same exciting, popular growth stocks, the next big thing, and they're usually paying way too much for the privilege. But then you've got the contrarian. This person is intentionally walking away from the party, digging through the bargain bin of unloved, unpopular stocks that nobody wants to talk about.
So this brings us to the big idea, the why behind all of this. It's a really powerful concept from psychology called the overreaction hypothesis. And once you understand it, the market starts to make a whole lot more sense.
So here it is. The investor overreaction hypothesis basically says that as investors, we are not the cool, rational machines we pretend to be. Not even close. When we hear good news about a company, we get euphoric. We imagine this endless runway of success, and we bid the stock price up into the stratosphere. And on the flip side, when there's bad news, we panic. We assume the company's doomed, and we sell, crushing the stock price far below what it's probably worth. It's this constant, predictable, emotional pendulum swing.
And what's cool is that this theory makes 3 really clear predictions you can actually test. First, the hot stocks will almost always be too expensive, and the loser stocks will be too cheap. Simple enough. Second, our own predictions are totally biased. We get way too optimistic about the winners and ridiculously pessimistic about the losers. But here's the third one, and it's the real moneymaker. Eventually, reality catches up. Those high-flying stocks can't possibly live up to the hype, and they come back down to earth. And those beaten-down stocks, well, they often just have to be a little less terrible to surprise everyone, and their prices rebound. It's a classic regression to the mean. Extremes just don't last forever.
So what's really going on in our brains here? The research points to this one word, affect. It's just a fancy psychological term for our gut feeling, our emotions. It's that warm, fuzzy feeling you get owning a stock with a great story, and that sick feeling in your stomach when you think about buying a company that's been in the news for all the wrong reasons. That feeling, that affect, is so powerful that it makes us completely ignore the numbers right in front of our faces.
Okay, the theory sounds really compelling, right? But talk is cheap. Does it actually work in the real world? Does the math back it up? Well, let's get into the data, because this is where things get really interesting.
Just look at this chart. This covers the period from 2000 to 2010. People call it the lost decade for a reason. You had the dot-com bubble burst and the 2008 financial crisis. I mean, it was an absolute bloodbath for most investors. But look at this. While the overall market went basically nowhere, these 4 different contrarian strategies, buying cheap stocks, didn't just survive, they thrived. They delivered incredible returns during one of the toughest decades on record.
Now, let's zoom out. This wasn't just a one-decade fluke. This chart covers 41 years of data. It takes all the stocks and sorts them into 5 buckets based on their price-to-earnings ratio. Take a look at the far left bar. That's the cheapest 20% of stocks. Their average annual return? A whopping 15.2%. Now look all the way to the right. Those are the most expensive, most popular, glamour stocks. Their return? A measly 8.3%. That is a huge gap. You literally could have almost doubled your yearly return year after year just by buying what was unpopular instead of what was popular.
And maybe you're thinking, well, maybe PE is just a flawed metric. Fair enough. So let's look at it another way. Price to cash flow. A lot of pros consider this a much cleaner way to value a business. And guess what? It's the exact same story. The cheapest stocks on the left returned 14.1% a year, crushing the most expensive ones on the right. The pattern just keeps showing up.
Just to really hammer this point home, let's try one more classic value metric, price to book value. And there it is again, almost the same picture. The cheapest group delivered 14.3% a year. I mean, it doesn't matter how you slice it or dice it. The evidence is just crystal clear. The market consistently gets it wrong on unpopular companies, and that creates this incredible, persistent opportunity for people who are willing to look.
So it all boils down to this number, 6.9%. That's the average yearly advantage you got from buying the cheapest stocks instead of the most expensive ones. Now, I know 6.9% might not sound like a life-altering number in any single year, but when you let that compound over an entire investing career, it is the difference between retiring comfortably and creating true generational wealth. It's absolutely massive.
So this is all great, but how do we actually do it? How do we find these companies that the market has written off? Well, the research points to 4 pretty simple, time-tested strategies.
Here they are. This is basically your Contrarians toolkit. These are 4 different lenses you can use to hunt for value. You're looking for companies that trade at a low price relative to their earnings, or their cash flow, or the value of their assets. And the fourth one, a high dividend yield, that's often a dead giveaway that the market is super pessimistic because the stock price has been pushed down so low that the dividend payment looks huge in comparison.
All right, I want us to think about investing in a slightly different way for a minute. You know, successful investing isn't about being a fortune teller. It's not about having a crystal ball. It's a game of odds. It's all about finding a strategy that stacks the long-term probabilities so heavily in your favor that, over time, it becomes really, really hard to lose. And this quote just says it all. Think about how a casino makes money. They don't win every single hand of blackjack, right? They don't have to. They just need a small, consistent edge, a few percentage points in their favor. Over thousands and thousands of hands, that small edge guarantees they make a fortune. Well, what the data is telling us is that using these contrarian strategies gives you an even better edge over the market than the casino has over you. You get to be the house.
So what does being the house actually look like in cold, hard cash? Check out this table. Let's say you invested 10 grand a year for 25 years in just the regular stock market. You'd have done great. You'd have about $1.37 million. But if you'd put that same 10 grand a year into a portfolio of these cheap, low PE stocks, you'd be sitting on over $2.6 million. That's nearly double the money. That's what a statistical edge can do for you. It's life-changing.
Okay, if you're still skeptical, this number should put it to rest. This is from a massive computer simulation. It's called a Monte Carlo analysis, where they tested this low PE strategy over and over again across thousands of different possible market histories. So they ran 10,000 separate 25-year trials, and the strategy beat the overall market 9,998 times. No, that's not a typo. The long-term probability of success here isn't just good, it's practically a statistical certainty.
So if the data is this overwhelming and the strategy is this simple, why isn't every single person on Earth doing this? Why isn't everyone a contrarian millionaire? Well, here's the catch. The hardest part about this strategy has nothing to do with the stock market. The biggest challenge is you. This chart is a painful but absolutely necessary reality check. This is Fannie Mae. For decades, this was considered a bulletproof blue-chip stock. As it started to fall in 2007, it looked dirt cheap on paper. A classic contrarian play, right? Wrong. Being a contrarian doesn't mean you turn off your brain. It doesn't mean you just buy stuff because it's down. Fannie Mae was a value trap, and it went to zero, wiping everybody out. It's a brutal lesson that cheap isn't enough. You still have to do your homework.
And the source material offers two priceless lessons from that disaster. First, and this is critical, never ever buy a company that is consistently losing money. All those studies we just looked at, they all screened out money-losing companies. Chronic losses are a fire alarm telling you something is fundamentally broken. And second, never just blindly believe what executives or government officials are telling you during a crisis. While everyone was on TV saying Fannie Mae was sound, the whole thing was rotting from the inside out.
And this really brings us right back to the beginning. That same human psychology, that tendency to overreact, is your greatest weapon as a contrarian. It creates the bargains you're looking for. But that same psychology, your own fear, your own greed, your own herd instinct, is also your worst enemy. The numbers only work if you can find the mental toughness to stick with the strategy, especially when it feels awful, when everyone is telling you you're wrong. And for most people, that's just too hard to do.
So we end up here. The evidence is about as clear as it gets in the world of finance. The strategy itself is dead simple. The only real question mark is you. It's not about whether the strategy works. We know it does. The only question is, do you have the discipline, the stomach, to actually put it to work and see it through? Something to think about. Thanks so much for joining me.
Welcome to The Explainer. All right, let me ask you something. What if you could get the safety of an index fund? You know, owning a piece of every major industry, but with a track record of doubling the market's returns? Sounds too good to be true, right? Well, today, we're diving into a powerful, data-backed strategy that does just that. And it all comes down to one simple, completely counterintuitive idea: betting on the unloved winners.
We all like to think we can, don't we? It's human nature. We get drawn to the all-stars, the companies that are constantly in the headlines, the ones everyone's raving about. But here's the thing. What if that instinct, that confidence we have in picking the obvious winners, is actually a trap?
Think about it. All that hype, the glowing analyst reports, the constant media buzz, it all conspires to drive the stock price of these darling companies through the roof. And that creates a bar for performance that is just impossibly high. I mean, even the best companies in the world can't be perfect all the time. When expectations are in the stratosphere, any little hiccup can send the stock tumbling.
So here's our game plan for today. First, we're going to really break down this all-star stock trap and why it catches so many people. Then, I'm going to introduce you to a new kind of contrarian approach that completely flips the script. After that, and this is the fun part, we'll get into 16 years of hard data that proves this thing actually works. We'll even explore the psychology of why it works. And finally, we'll talk about how you can actually build a portfolio like this for yourself.
Okay, so let's dig into that first point. The core of the problem is that as investors, we love a good story. We get caught up in the excitement, the trends, and we become way too confident that we can spot the next big thing. And that natural bias pulls us, like moths to a flame, toward those popular and, as we just talked about, dangerously overpriced stocks.
So if chasing the popular kids is a losing game, what's the alternative? This brings us to a totally different way of thinking, a new contrarian approach. See, the secret here isn't about trying to pick the best stock in the whole market. No, it's about changing your entire process. It's about how you buy, not just what you buy. It's a system, and it's designed to save us from our own worst instincts.
Now this right here, this is the light bulb moment, the big idea. Forget agonizing over whether tech is a better bet than insurance right now. This strategy says, hey, those human biases we've been talking about, they're everywhere. That means you can find incredible value by finding the underdog in every single industry, whether it's high-flying software or good old boring banking.
So here's the nitty-gritty, the one simple rule. You systematically buy the 20% of stocks that are the cheapest relative to their direct competitors. We measure cheap using things like the price-to-earnings ratio, or PE. Now, a cheap tech stock might have a PE of, say, 30, while a cheap utility stock might have a PE of 10. The specific number doesn't matter. What matters is that they are both the unloved, overlooked players in their own specific neighborhood. And this is such an important distinction to make. You see, a traditional deep value guy might get stuck buying stocks only in industries that nobody likes. Think steel mills or department stores. But this industry relative approach, it unlocks the entire market. You get to play in every sandbox, even the exciting ones, simply by picking the companies that have been unfairly pushed to the side.
Okay, this all sounds pretty smart in theory. But we always have to ask the big question, does it actually work in the real world? Especially when things get rocky. Well, to figure that out, we're going to look at a massive study. It tracked the 1,500 biggest U.S. companies across 68 different industries, all the way from 1995 to 2010. And remember, that period includes the dot-com bubble and the 2008 financial crisis, so this strategy was put through the ringer.
And the results? Well, they're not subtle. Just look at this chart. That bar on the far left, that's our portfolio of unloved stocks, the ones with the lowest price-to-earnings ratios. They cranked out an incredible 13.9% return per year. Now look at the middle bar. Those are the darlings, the most expensive stocks. They only got 11.3%, and the market as a whole, on the right, barely cracked 10%. The takeaway is undeniable. The unloved stocks didn't just win, they blew the competition away. Now I know what you might be thinking. 3.7%? That doesn't sound like a life-changing number, but you absolutely cannot underestimate the power of that edge. Over 16 years, that small, consistent outperformance compounds into a massive, massive advantage for your portfolio. It's the difference between a decent outcome and a truly fantastic one. And believe it or not, it gets even better. When we switch the metric we use to price to cash flow, which frankly a lot of pros think is a more honest look at a company's financial health, the results get even more dramatic. Using this lens, the cheapest 20% of stocks delivered a jaw-dropping 15.1% return every year. Just look at the chart. That is nearly double what the expensive stocks returned, and it's a full 5 percentage points better than the market, every single year.
So let's stop talking about annual percentages for a second and look at the total picture. 102% outperformance. What that means is, by the time the 16-year study was over, this simple strategy had generated more than double the profit of just passively investing in the market.
And this chart really brings it all home. Check out that top line. That's our low price to cash flow strategy. If you had put just $10,000 in back in 1995, it would have grown to $95,000. Now follow that bottom line. That's the overall market. That same $10,000 only grew to $47,000. Our contrarian portfolio literally more than doubled the market's result. That, my friends, is the awesome power of compounding better returns over time. But hang on. A skeptic might say, well, sure, but aren't you just buying stocks in cheap, junky industries?
And the data gives a crystal clear answer. Absolutely not. This table is so revealing. It shows that it doesn't matter if you're fishing in the most expensive, glamorous industries or the cheapest, most boring ones. The strategy of buying the cheapest stocks within that group still wins big time. It delivered over 13% in the hot sectors and over 14% in the boring ones. Both crush the market. The principle works everywhere. So we've seen beyond a shadow of a doubt that it works, and with incredible consistency. But now for the really fascinating part. Let's explore the powerful psychological reason why it works. Because the engine driving these amazing results isn't on a spreadsheet. It's hardwired into our brains.
This quote really just nails it, right? It's the simple, actionable rule at the heart of everything we're talking about. And the reason this rule is so powerful is because it exploits a predictable glitch in human psychology, a cognitive bias that behavioral scientists call affect.
To put it simply, our gut feelings about a company, whether we just have a good feeling about it or a bad one, cause us to make predictable mistakes. We get all excited about the darlings, the winners, and we bid their prices up way too high, creating those impossible expectations we talked about. And at the same time, we get overly negative about the laggards, pushing their prices down way too low, which creates the perfect setup for a positive surprise. This strategy is built to systematically take advantage of that error over and over again.
Okay, so the data is rock solid, and the psychology behind it just makes sense. So how do we actually turn this into a real-world investment playbook? Let's talk about the practical advantages of building a portfolio this way.
Well, when you put this all together, your portfolio gets some really powerful benefits. First, you get amazing diversification. You have a stake in dozens of different industries, so you're never going to completely miss out when a certain sector gets hot. Second, this isn't passive investing. You're actively tilting the odds in your favor for higher returns. And finally, there's a built-in discipline. Once a year, you rebalance. You sell the stocks that have done well and are no longer cheap, and you buy the new class of underdogs. It forces you to do what we all know we should, buy low and sell high.
And here's one of my favorite parts about this whole thing. It plays defense. This chart shows what happened during the absolute worst quarters of that 16-year study. While the market as a whole was getting hammered, falling an average of 8.1%, these contrarian portfolios fell significantly less. Remember, winning in investing isn't just about what you make in the good times, it's about what you don't lose when things get ugly. This strategy is designed to protect your capital.
All right, so let's bring this all together. What is the single most important thing to take away from all this? Well, this strategy gives you a clear, data-driven edge, but it's really important to be realistic about what it can do for you and what it can't.
Look, this is not a magic crystal ball. It is not going to tell you when to get out of the market or when to jump back in. And while it works in most bad markets, it's not going to be perfect in every single one. But here's what it will do. It will consistently put the odds in your favor by finding the best relative opportunities out there. It will help you protect your capital by declining less in most bear markets, and as we've seen in the data, it has the power to deliver absolutely staggering returns over the long haul.
You know, in the end, the biggest obstacle to this strategy isn't a market crash or a bad economy. It's the person staring back at you in the mirror. The data we've looked at today is crystal clear. The logic is simple and powerful. But every single day, the market is going to tempt you with a new shiny object, a new can't-miss winner. So the real question isn't whether the strategy works. The real question is, do you have the discipline to ignore the noise, control that urge to chase the winners, and quietly follow the data? Thanks for joining The Explainer.
Let's talk about something that I think a lot of us have been feeling for a while now. This feeling that when it comes to investing, we're not on solid ground anymore. It's different. It's like we've been dropped into a new alien world where none of the old maps work. And honestly, it feels a little dangerous. So today, we're going to explore this new landscape, figure out what the real threats are, and most importantly, give you a plan to get through it.
You know, the source material for this explainer starts with this quote, and it just hits the nail on the head, doesn't it? That's exactly how it feels. You're out there, floating in this weird zero-gravity environment where the old rules just don't seem to apply. Every move you make feels uncertain, and that home base of, stable, predictable markets feels a million miles away. This isn't just a clever line, it's the reality we're all dealing with.
For years, maybe even decades, we had these principles we could count on, right? But now, in a world where things like flash crashes are a real thing, that ground has completely shifted under our feet. The game has fundamentally changed, and that means we need a totally new set of tools just to survive.
So, here's our mission briefing. First, we'll get the lay of the land in this alien world and identify its, let's call it, apex predator.
Then we'll dissect what happens when that predator attacks. After that, we'll build your personal survival kit with some real actionable strategies. And finally, we're going to tackle the hardest decision any investor has to make: when to sell.
Okay, so every new ecosystem has a dominant species, right? Well, in this new investment world, that species operates at literally the speed of light. It's a force that has completely reshaped the markets in just a handful of years, and understanding what it is, that's the absolute first step to protecting yourself. So let's go ahead and identify this apex predator.
So what in the world is high-frequency trading, or HFT? Well, first, forget everything you think about traditional investing. You know, guys in suits poring over balance sheets. HFT firms are staffed with PhDs in physics, math geniuses, and coding wizards. Their whole mission is to use these incredibly powerful computers and super-fast data lines to fire off millions of trades, trying to make just a tiny fraction of a penny on each one. It's all about speed, and we're talking millions of a second.
And their takeover of the market, it was just astonishingly fast. I mean, look at this. In the early 2000s, HFT was a tiny slice of the pie, just 10% of the market. By the middle of 2009, it was responsible for almost 75% of all U.S. trading volume. That's a complete rewiring of how the market works, and it happened in less than a decade.
And look, they don't just win because they're fast. They use these incredibly complex and frankly aggressive tactics. For instance, something called gaming. That's where their algorithms can actually sniff out that a big mutual fund is about to make a huge buy, and they jump in a microsecond ahead of it to profit. Iceberging is the opposite. They hide their own giant orders from you by only showing a tiny little piece to the market. And then you have quote stuffing, where they can just flood the system with thousands of buy and sell orders a second and then cancel them, basically creating a smokescreen to confuse everyone else.
And this quote from George Fager really gets to the heart of it. It lays out the fundamental difference in philosophy. HFT couldn't care less about the long-term value of a company. It's not about investing in the next great idea or supporting growth. It is a pure, high-speed game of exploiting microscopic price differences that exist for only a fraction of a second. They're not investors. They're traders in the most extreme sense of the word.
All right, so we know who the predator is. But what happens when that predator is let loose in a market that's already stressed out? Well, these moments, these so-called flash crashes, are when the incredible fragility of this new high-speed system gets exposed for everyone to see. These are the moments the aliens attack.
Let's walk through the timeline of the infamous flash crash on May 6, 2010, and you'll see what I mean. The market was already having a pretty rough day, down about 3%. Then, at 2:42 p.m., one single large mutual fund put through a $4.1 billion futures trade. The HFT algorithm saw it and reacted instantly. But here's the thing. Instead of providing stability, they did the exact opposite. They pulled all their buy orders and started selling, aggressively. And in the vacuum that created, the Dow just fell off a cliff, dropping almost 1,000 points in minutes.
And here's the price tag for that chaos. In less than 10 minutes, $862 billion in market value just vanished. Poof, gone. Now, regulators did step in and cancel some of the most ridiculous trades, but the damage was done. It absolutely shattered people's confidence. It was this terrifying look at how all these automated systems, all reacting to the same signal at the exact same time, could spiral into total catastrophe.
And if you're thinking, okay, well that was a freak one-off event, it really wasn't. Take a look at the panic back in August of 2011. The S&P 500 was plunging, the VIX, fear index, more than doubled to extreme levels. And what did HFT do? Look at this bottom row. Its share of the market volume surged from 53% all the way to 65%. They weren't running from the fire, they were pouring gasoline on it.
Adam Sussman from the Tab Group just summed it up perfectly here. The exact same panic and chaos that makes regular investors like you and me want to run for the hills, that's the perfect hunting ground for HFT algorithms. All that extra volume and volatility just creates more and more opportunities for their lightning-fast strategies. See, one person's panic truly is another's profit.
Okay, so that was the bad news. We've laid out this hostile new environment and its dangers. But I promise you, you are not helpless. Now we get to pivot to the good news, which is building your survival kit. These are the tools, the strategies, the things you need to do to protect yourself and actually invest smartly in this crazy new world.
This is the big question, right? It is so easy to feel overwhelmed, to feel like the game is completely rigged against you. But here's the thing.
You don't have to compete with them on their terms. The goal is not to outtrade the machines. The goal is to build a portfolio that is resilient to the machines. Let's dig into how you do that.
Okay, pay attention, because this is probably the single most important defensive move you can make. In the old days, we all used market orders and stop-loss orders. They were standard. In today's world, they are incredibly dangerous. A market order during a flash crash means your stock gets sold for whatever insane bottom-of-the-barrel price is on the screen for that millisecond. A stop-loss can get triggered by a tiny, algorithm-driven dip, locking in a huge loss on a stock that might bounce back 2 minutes later. The source material literally calls it Russian roulette. So what's the safe alternative? A limit order. It's simple. You set your price. You tell the market, I will not sell for 1 penny less than this amount. It puts you back in control and protects you from those crazy, violent, and temporary price swings.
So let's fill out the rest of that survival kit. First, just stay away from highly speculative stuff like options or VIX products. The costs are really high, and you are playing in a sandbox with experts who have every single advantage. Second, use exchange-traded funds, ETFs, to easily diversify across a whole industry you like. This cuts down your single stock risk. Third, if you're going the route of managed funds, look for mutual fund managers with a proven track record, and I mean at least 10 years of solid performance. And fourth, don't forget about the simplest tool of all, low-cost index funds. They're a cheap and super effective way to just own the entire market.
And this chart from the source material is a great example of what we mean by a long-term record. It shows a few large-cap value funds and their 10-year returns. Now, the specific funds here aren't the point. The principle is, you want to see hard evidence that a manager has successfully navigated all kinds of market cycles, good times, bad times, and everything in between, before you hand over your hard-earned money. All right, we've got our defenses up. We've picked our investment vehicles. But now we have to face the final boss of investing, and that's our own psychology. Knowing what to buy is one thing, but knowing when to sell, that is the toughest call of all. And it's where our emotions can do the most damage.
And that really is the ultimate challenge, isn't it? When a stock is flying high, greed kicks in and tells us to hold on for just a little more. When it's tanking, fear makes us want to panic and sell at the absolute bottom. Or maybe it's just stubbornness, convincing us to hold on to a loser because it's bound to turn around. To succeed, you have to find a way to take emotion out of the driver's seat. You need a system.
And here is a system that does exactly that. This is a powerful guideline. The idea is to sell a stock when the original reason you bought it no longer exists. So for example, let's say you bought it because it had a really low price-to-earnings ratio, a low PE. Well, this rule says you sell it when that PE has climbed up to match the market average. And here's the most important part. You do it regardless of how favorable its prospects may appear. This is a mechanical rule. It's designed specifically to protect you from your own hype and excitement when a stock has had a great run.
We can really boil this whole philosophy down to 3 simple rules of engagement. Number 1, don't be greedy. Your stock hit its target, you made a good profit, ring the register and move on. Number 2, don't be stubborn. You have to give a stock a fair shot, say 2.5, 3 years, but if it's just not working, you have to be willing to cut it loose. And number 3, don't be afraid to take a loss. If the fundamental reason you bought a company changes for the worse, sell it. Sell it immediately. The first loss is almost always the smallest loss.
So, when all is said and done, the big takeaway here is that investing in this new alien world is not about having a crystal ball. You are not going to outpredict the algorithms, and you are not going to time the next flash crash. Success today comes from acknowledging the new reality, understanding the dangers, and having a disciplined, rules-based plan with the right protective tools to navigate whatever the market throws at you today.
And we'll leave you with this one last thought to chew on. We've spent this time talking about how to adapt to the world as it is right now. But what happens as these automated systems get even faster, even smarter, and even more dominant? Is it possible that the very act of long-term fundamental investing as we know it could become obsolete? Will we all have to completely change our definition of what it means to be an investor just to survive in the markets of the future? Something to think about. Thanks for joining me.
You know, it's funny how we think about risk, isn't it? We'll sit on the edge of our seats, cheering for the long shot in a game. But the second it comes to our own money, suddenly we want a sure thing. We want the odds stacked in our favor. The problem is, when it comes to investing, figuring out what the odds really are has become, well, incredibly complicated. For decades, we thought we had it all figured out with this one neat, elegant theory. But today, we're going to watch that theory get absolutely taken apart by the facts.
So let's pull back the curtain and see where it all went so wrong.
I think this quote from Thomas Huxley just nails it. It perfectly sets the stage for what we're talking about today. We are about to see a beautiful, widely accepted idea about investment risk get slain by some very, very ugly facts. For years, for a long, long time, the entire world of finance was built on this one core idea of what risk means. But as we're going to see, the real-world data, it tells a completely different and, frankly, a much more shocking story.
All right, so let's get to know the main character in this old story. For our purposes, we'll just call him Mr. Volatility, or maybe Mr. Risk. For decades, this was the guy everyone listened to. He was clear, he was precise, and he gave us a single number to measure just how risky something was. The entire theory of efficient markets was basically built around this one character, and we thought, great, we finally tamed the risk demon that's been scaring investors for centuries.
And the idea itself was actually pretty straightforward. Risk was just volatility. It was often measured by something called beta. The more an investment's price bounced up and down day to day, the riskier it was. That's it. This was the bedrock of portfolio management. You could supposedly fine-tune your investments with incredible precision, all based on this one neat little calculation. It was elegant, it was easy to wrap your head around, and pretty much everybody bought into it.
And here it is. Here comes the twist. The ugly fact. When economists and analysts finally looked at decades of performance data, they found a massive problem. Mr. Volatility's numbers, they just didn't work in the real world. There was no actual meaningful connection between how much an investment bounced around and the real returns you got over the long run. The beautiful hypothesis was dead. The very foundation of modern risk analysis was, to put it nicely, not very useful.
So this leaves us with a huge question, right? If volatility isn't the main villain, then what is? If the thing we've all been taught to fear isn't the real danger, then we need to figure out what the true threats to our long-term wealth actually are. It's time to unmask the real villains, the risks that this old way of thinking completely ignored, but have been doing immense damage to people's portfolios for centuries. It's time to meet the four horsemen.
And here they are. These are the four big risks that have historically done the most damage to investors. We're talking about liquidity, or more accurately, the lack of it. We're talking about leverage, that dangerous amplifier. And then there are the two silent destroyers that just creep up on you, inflation and taxes. Let's just touch on the first two real quick.
A lack of liquidity has been a market killer pretty much since markets began. It's that moment when you desperately need to sell, but there's no one buying, at least not at any reasonable price. That's what drives panics. Now, leverage, that's investing with borrowed money, is like pouring gasoline on that fire. The 1987 crash, the 2008 crisis, you look at almost any major financial disaster and you'll find this deadly combination at its heart. Way too much leverage and then a sudden, shocking lack of liquidity. It can bring the whole system to its knees.
But of all these horsemen, there's one that became the sneakiest, most insidious risk for the average long-term saver, especially in the modern era. You see, for over 100 years before World War II, inflation was basically a non-issue. But after the war, everything changed. Inflation became this permanent, stealthy force that could silently eat away at the value of your savings. And it completely flipped the script on what was considered a safe investment.
Okay, now this slide right here, this is the ugly fact we've been talking about, in all its glory. This table shows the real, compounded returns of stocks, bonds, and short-term T-bills from 1946 to 2010. And the key here is that it's after accounting for inflation. This shows what your money could actually buy. What you're about to see, it completely turns the conventional wisdom about risk upside down.
The data here tells a truly astonishing story. If we zoom in on that 30-year holding period from the table, we see the real difference. After inflation, stocks grew your purchasing power by a whopping 563%. And bonds, the safe asset, a measly 61%. Let that sink in for a second. The asset class everyone called risky outperformed the safe one by 9 times over. The so-called safe investment barely even kept your head above water.
For 150 years, there was this thing called the prudent man rule that guided how people invested. It basically said that a sensible person sticks to safe bonds, maybe with just a little sprinkle of stocks. And you know what? In a world with no inflation, that works just fine. But after World War II, in this new era of permanent inflation, following that old rule became a recipe for disaster. It actively destroyed the real value of people's life savings. The nature of risk had changed, and millions of people paid the price for not realizing it.
As if the inflation data wasn't bad enough, now we have to bring in the fourth and final horseman, taxes. You see, the government taxes the interest you earn from bonds, even if that interest is just barely keeping up with the rising cost of living. This just adds another layer of drag on your returns, and it delivers a final crushing blow to the idea that bonds are some kind of safe, long-term haven for your money.
So let's look at the data one more time. This table is the same as before, but now we've also factored in the average top tax rate from that period. This is the ultimate bottom line. This is what's actually left in your pocket, what you can actually go out and spend after both inflation and taxes have taken their bite. And the picture? Well, it gets even more bleak.
This number is just staggering. If you'd invested in so-called risk-free, long-term government bonds for 30 years, after accounting for inflation and paying your taxes, you would have lost nearly half, 45.8% of your original purchasing power. Think about that. You played it safe, you were prudent, and your reward was watching your wealth get systematically destroyed. It's the very definition of a loser's game.
So what's the antidote to all this? What's the secret weapon? Well, it's time. This chart shows you the probability that stocks will beat bonds after inflation over different periods. In any single year, yeah, it's a bit of a toss-up, around a 63% chance. But just look what happens as you stretch out your time horizon. After 30 years, in every single rolling 30-year period from 1946 to 2010, stocks have beaten bonds 100% of the time. Time is the thing that transforms short-term volatility into long-term certainty.
All of this evidence really forces us to completely rethink what risk truly is. The real risk isn't that your portfolio is going to bounce around in the short term. The catastrophic risk is that over the long term, your savings won't be there for you when you actually need them. That they won't have the purchasing power to pay for your retirement or whatever your long-term goals are.
So this leads us to a much better, much more practical definition of risk. Real risk isn't about the daily zigs and zags, it's this. It's the probability that your investments will fail to grow your real, after-inflation, after-tax purchasing power over your actual time horizon. This definition actually lines up with what matters to real people, having enough money for their future. It's practical, it's based in reality, and it leads to very, very different conclusions about what's truly safe.
Okay, so what does this all mean for you? Well, first, you have to learn to ignore the daily noise. For a long-term investor, the data is just crystal clear. The real risk is not owning assets like stocks that can actually outpace inflation. Think of bonds and savings accounts as places to park your short-term cash, not as long-term wealth builders. And here's the key psychological flip you have to make. Inflation and taxes actually reduce your risk in owning stocks over time because stocks are your best defense against them. At the same time, those same forces dramatically increase your risk in owning bonds. I absolutely love this quote from the pioneer of behavioral finance, Richard Thaler. He's so right. Our obsession with getting a price quote on our stocks every minute of every day causes us to make foolish, emotional decisions based on short-term volatility. If we thought about our stock portfolio the way we think about our house, as a long-term asset whose value we don't check every 5 minutes, we would all be far, far better off financially.
And that really brings us to the final question, one you should really ask yourself. After seeing all this evidence, take a good hard look at your own investment strategy. Is it built to protect you from the temporary discomfort of market ups and downs? Or is it built to protect you from the permanent and devastating risk of not reaching your long-term financial goals? The answer to that question could truly change your entire financial future.
You ever get that feeling that the game is, well, that it's rigged? You know, that no matter how well you play, the house always wins? Well, today we're going to dig into the 2008 financial crisis, and you're going to see how it was pretty much a high-stakes casino game. But this was a game where the biggest players on Wall Street weren't just running the tables. They were actually building a roulette wheel they knew you could never, ever beat. So let's see exactly how they pulled it off.
Just imagine this for a second. You walk into this incredibly lavish casino, let's call it the House of Goldman Sachs. The staff? They're all impeccable, super sharp, polite, every one of them has an advanced degree. They're there to guide your investments, right? They're offering you expertise on hundreds of games, from these complex things called synthetics to brand new exotics, and they promise you they will always help you maximize your odds of winning.
So you walk across the floor, the place is just buzzing with energy. Chips are piled sky high everywhere. You decide, smartly, to play a game you actually get, roulette. You walk up to this beautiful mahogany table, you put down a few chips, and the croupier gives the wheel a spin. The ball lands on green. Whoa, long shot. So you bet on red, figuring you've got a pretty good 50-50 shot. The dealer spins again.
And it lands on green. Again. And then again. You're just staring, completely stunned. Green comes up 8 of the first 10 spins. I mean, the odds of that are just impossible. So, seeing this incredible streak, you think, okay, this is it. And you push your entire stack of chips onto green. It's obviously the winning number. But the croupier, he just calmly pushes your chips right back to you. You look up at him, totally confused.
And he tells you, "I'm sorry, sir, green is not allowed to be played against the house. The whole thing was rigged from the start." Now, of course, this is just a story, but the financial system that blew up our economy in 2008, it operated on a principle that was shockingly similar. You just weren't supposed to know the real rules of the game.
So who were these guys? Who were these, masterful financial engineers who spent decades literally changing the rules of the game? To get that, we have to start with one of the most powerful economic figures of our time, the chairman of the Federal Reserve, Alan Greenspan.
See, Greenspan wasn't just an economist. He was a true believer. He was driven by this powerful ideology he picked up from the author Ayn Rand. It's called laissez-faire capitalism. And at its core is this rock-solid belief that markets, if you just leave them completely alone, will regulate themselves through self-interest. To him, government wasn't the solution, it was the problem. And this wasn't just some casual opinion. It was the philosophy that drove every single major decision he made for almost 20 years.
And this quote right here, it just perfectly sums up his entire mindset. Back in '96, he made the case that if you just let banks do whatever they wanted, the market would magically keep them in line. If they took on too much risk, the market would punish them. He truly believed the system could police itself. But the fatal flaw in that thinking, and the world found this out the hard way, was underestimating just how complex and tangled up modern finance had become, where one bank's bad bet could set off a chain reaction and take the whole world down with it.
And this philosophy of his, it wasn't just talk. It led to a total, systematic takedown of all the financial guardrails that were put in place to prevent another Great Depression. It started in the late 80s, when his Fed began chipping away at the Glass-Steagall Act. That was the law that kept your safe, boring savings bank separate from a risky, high-flying investment bank. Then, in 1999, he was right there celebrating its full repeal, completely tearing down that wall. A year later, in 2000, they passed a law that specifically blocked anyone from regulating a new, shady market for these things called derivatives. And even as late as 2003, with alarm bells ringing everywhere, Greenspan told Congress it would be a huge mistake to regulate them.
And what's wild is that the warnings weren't coming from nobodies. We're talking about the absolute giants of finance. George Soros wouldn't touch these things. Felix Rohatyn, the legendary banker who literally saved New York City from going bankrupt, called them hydrogen bombs. And of course, most famously, Warren Buffett called them financial weapons of mass destruction. The alarms were screaming at the highest levels, but they were just ignored. The coast was clear. The casino was officially open for business.
So if deregulation built the casino, what was the rigged game? Well, it was the subprime mortgage market. See, after the dot-com bubble burst around 2001, Greenspan's Fed dropped interest rates down to almost nothing. This unleashed a tidal wave of cheap money, and Wall Street found the absolute perfect place to point that fire hose: housing.
Suddenly, the goal was simple: get a mortgage into the hands of anybody. It didn't matter if they could actually afford it. And the products they came up with were just predatory by design. You had ninja loans, and no joke, that stands for no income, no job, no assets. You had negative amortization loans, where your payments were so low they didn't even cover the interest, so your debt actually got bigger every single month. And the most popular of all, adjustable rate mortgages, which hooked people with this low teaser rate that was specifically designed to explode into a payment they could never, ever afford just a couple of years later.
And the market for this stuff, it didn't just grow, it went supernova. I mean, just look at this chart. In only 4 years, the share of these toxic, incredibly risky loans went from being a pretty small slice of the market, about 7%, to over a fifth of all new mortgages being handed out in the United States. The people writing the loans, they didn't care about the quality because they weren't the ones holding on to the risk. The entire financial system was being systematically flooded with poison.
So where were the regulators in all this? Well, even though he got years of very clear warnings from people inside his own organization, like Fed Governor Edward Gramlich, Greenspan flat out refused to use his authority to stop any of these predatory lending practices. In fact, the Fed actually blocked states that were trying to crack down on the worst offenders themselves. And when he was later asked about this colossal failure of oversight, Greenspan just said, "I turned out to be wrong."
Not much comfort for the millions of people whose lives were about to be destroyed.
Okay, so this brings us to the really crucial part. This is how Wall Street took all those millions of bad loans and turned them into a massive money-making machine. This is where the game becomes truly, truly rigged. The investment banks, see, they didn't just sell off these toxic mortgages. They created a system where they could make money selling the loans and then make even more money when those same loans inevitably failed.
They did it with this thing called a collateralized debt obligation, or a CDO. Now, it's complicated, but just think of it like this. You take thousands of those horrible subprime mortgages, you throw them all into a big digital bucket, and then you slice up that bucket into brand new products that you can sell to investors who don't know any better, like pension funds or cities. It was basically financial alchemy, a way to take a pile of garbage and magically make it look like a five-star meal.
But wait, how do you sell garbage and call it gold? Simple. You get someone to give it an official seal of approval. And that's where the credit rating agencies came in. Companies like Moody's and Standard & Poor's. I mean, these were institutions with 100-year-old reputations for being totally trustworthy. But during the bubble, they became what investigators later called AAA factories. For hundreds of millions of dollars in fees from the banks, they just started slapping their highest possible rating, AAA, on thousands of these toxic mortgage bundles.
So why on earth would they risk their reputation like that? Well, you know the story about the infamous bank robber Willie Sutton? Someone once asked him why he robbed banks, and he said, because that's where the money is. For the rating agencies, all the money was in rating these complicated products. Moody's revenue from this one business line alone shot up over 500%. The incentive to just look the other way wasn't just there, it was overwhelming.
And if you want to see the rigged game in action, you don't have to look any further than the House of Goldman Sachs itself. This table right here is straight from a U.S. Senate investigation, and it is the smoking gun. It shows these huge deals that Goldman packaged and sold to its own clients, all with a shiny high rating stamped on them. But here's the crazy part. At the exact same time they were selling this stuff, Goldman was placing massive, secret bets that these very same assets would fail. They weren't just the dealer. They were betting against every single player at their own table.
And there's absolutely no question about whether they knew what they were doing. This is a direct quote from an internal Goldman Sachs email. They're talking about a billion-dollar package called Timberwolf that they were actively selling to their clients. The email couldn't be clearer. Boy, that Timberwolf was one shitty deal. They knew. They knew exactly what they were selling. They built the rigged wheel, and now they were cashing in by betting against the very people they'd invited to play.
So what happened when the wheel finally stopped spinning? When the whole system just froze? The financial world came right to the edge of total collapse. But the banks, the very architects of this crisis, they were called too big to fail and were handed hundreds of billions of your tax dollars in bailouts. And the players they tricked? Millions of regular people lost their homes, their jobs, their entire life savings. The guys who caused it walked away with their bonuses, while the public got stuck with the bill.
So, what's the lesson in all this for the rest of us? First, you have to be super wary of complexity. If you can't understand an investment product, it's almost a guarantee that it's designed to make the seller rich, not you. Second, you have to understand that even when a company has a fiduciary duty to act in your best interest, that duty can just evaporate when the profits get big enough. And finally, when you're dealing with products that aren't regulated, you've just got to assume that the seller's interests are the only ones that really matter, not yours.
In the end, the casino got bailed out by the very same people it took advantage of. Sure, some new rules were passed and a lot of promises were made. But it leaves us all with this one big, really unsettling question. The banks were saved, we know that for sure. But was the game itself ever really fixed? Or is that same wheel still spinning out there, just waiting for the next round of players?
You know, for centuries, we've heard about the invisible hand of the market. It's this core belief in capitalism, right? The idea that everyone acting in their own self-interest just magically creates the best outcome for all of society. But what if that hand isn't so invisible anymore? What if in today's global economy, it's actually being guided by forces that the original champion of free markets, Adam Smith, specifically warned us about? Well, based on the source material we're looking at, we are going to dig right into that very question.
Okay, so let's start right here. This single quote, this is the foundation for so much of our modern economic world. Adam Smith's idea was frankly a game changer because it was so simple. When people are free to chase their own goals, they often end up helping everyone else almost by accident. It's a powerful concept, and it became the absolute bedrock of free market thinking.
So let's really get to know the man behind the idea, because the source points out this crucial detail that honestly gets overlooked all the time.
Now this is where it gets really fascinating. The source material shows us there are two sides to Adam Smith. We all know the first one, the champion of free enterprise. But here's the part that gets left out. He was also its fiercest critic. He warned, and he was very clear about this, that if you leave businesses completely unchecked, they will absolutely form monopolies and team up against the public to fix prices and bend politics to their will. He believed the invisible hand only worked if you were watching it very, very closely. But, despite those warnings, it was the simpler, more optimistic version of his theory that really took hold. Starting around the Reagan years and continuing on, both parties, Republicans and Democrats, pretty much embraced this deep faith in free markets, trusting that the invisible hand would just naturally sort everything out for the best.
All right, so with that foundation in place, let's see how these classic theories, the ones that literally shaped our modern world, hold up against the messy reality of the 21st century global economy.
So, the sidekick to the invisible hand is this theory from another economist, David Ricardo. And for 200 years, this has been the argument for free trade. The idea is simple. If, say, Portugal is awesome at making wine and England is great at making cloth, they both win if they just do what they do best and trade with each other. It's simple, it's powerful, and for a really long time, it worked incredibly well.
But here's the tough question the source material forces us to ask. This theory was born in a world of sailing ships and factories where all the workers lived down the street. Does a 200-year-old economic model really apply to our world of hyper-connected, instantaneous global supply chains?
And this is the crucial point. The basic assumptions Ricardo made, they're just gone. Back then, your workforce was pretty much stuck in your country, and shipping was slow and expensive. Today, capital, machinery, information, it all moves at the speed of light. And you have a global labor pool of billions of people you can tap into instantly. The entire foundation of the theory has been turned completely on its head. It's a different ballgame.
So let's look at the actual numbers, because this new reality has created economic pressures that guys like Ricardo just couldn't have possibly imagined.
This chart from the source just lays the challenge bare. Looking at the data from 2008, you see this staggering difference in labor costs. I mean, it's not a small gap, it is a chasm. The cost for an American worker was more than 10 times that of a worker in China, and an unbelievable 50 times more than a worker in India.
And let me put that in even sharper focus for you. The source points out that just the Social Security tax an American employer paid per hour was by itself more than triple the entire hourly wage of an average Indian worker. Think about that. When the tax on one worker is more than the entire salary of another, the economic pull to move jobs is just immense.
And hey, we're not just talking about factory jobs anymore. This huge wage gap has driven the outsourcing of millions of high-paying, skilled, white-collar jobs. As this table shows, a software engineer that might cost you $80,000 or $90,000 a year in the US, you could hire in India for around $10,000. The exact same pattern holds for customer service, accounting, you name it.
And of course, let's be honest, we're a huge part of this story. Our demand, as consumers, for lower and lower prices, that's what fueled what the author calls the Walmart revolution. It created this powerful incentive for companies to find the absolute cheapest way to make something anywhere on the planet, no matter what it meant for jobs back home.
But according to the source, this whole thing goes way deeper than just a difference in wages. It argues that the whole idea of free trade, as we think of it, is basically a myth, because not everybody is playing by the same rules.
The author uses this term, neo-mercantilism. Basically, it's a modern spin on the old-school protectionist policies that Adam Smith himself argued against. The goal isn't just to trade, the goal is to maximize your own country's exports while you systematically block or limit imports using a whole bag of tricks. And the source uses China as a prime example of this strategy. It's not just one thing, it's a whole toolkit. You've got keeping the currency artificially low to make your exports cheaper, putting up subtle but effective barriers to block foreign companies, especially in key areas like finance, and then the big one, massive intellectual property theft and counterfeiting.
And the scale of this counterfeiting, the number the source estimates is just staggering. We're talking about nearly $500 billion, $480 billion worth of illegally copied goods every single year. Everything from software and movies to car parts. Now here's where your jaws should hit the floor. You take that counterfeiting number and you put it next to this one.
The source points out that in 2010, the estimated value of just the counterfeited goods was 75% larger than the entire U.S. trade deficit with China for that year. That strongly suggests a huge chunk of that trading balance has nothing to do with fair competition.
So, the crucial point the source makes is this: we're not operating in some pure world of free trade. It's much more like a strategic board game, and the goal isn't mutual benefit for everybody. The goal is to be the player who ends the game with the biggest pile of cash by running the largest possible trade surplus.
Okay, so if the game is rigged, what do? Well, the source argues we need to shift our thinking entirely, away from free trade and toward what it calls fair trade.
The author lays out a much more assertive playbook. It means getting tougher in negotiations to pry open markets that are closed to us. It means using temporary tariffs as a tool, a penalty, against countries that are stealing intellectual property. It's about insisting on some basic environmental and labor standards to help level the playing field on costs. And it's also about using our own tax code to give breaks to companies that create jobs here at home and take them away from companies that ship jobs overseas.
This really gets to the heart of the problem we all face, doesn't it? It's a direct trade-off. On the one hand, hey, we all benefit from lower prices on TVs, clothes, you name it. But on the other hand, the source argues that this comes at a huge cost. Millions of jobs lost, a hollowing out of our industrial base, and maybe, just maybe, a lower standard of living for the next generation.
And in the end, the source leaves us with this really powerful and kind of uncomfortable question. It forces us to think about the true cost of all that stuff we buy. It's a choice that isn't just about economics. It's about what kind of country, what kind of future we actually want to build. It's a decision that really pits our wallets today against our collective prosperity tomorrow.